네, 잠시 안내 말씀드리겠습니다. 잠시 후 9시 30분부터 2021 글로벌 대체투자 컨퍼런스가 시작될 예정입니다. 오늘 컨퍼런스는 한국어와 영어 채널이 분리돼 유튜브로 생중계가 되고 있는데요. 컨퍼런스를 시청하시면서 궁금하신 점이나 질문이 있으신 분들은 채팅창을 통해서 질문을 해주시면 감사하겠습니다. 네, 다시 한번 안내 말씀드리겠습니다. 잠시 후 9시 30분부터 2021 글로벌 대체투자 컨퍼런스가 시작될 예정입니다. 오늘 컨퍼런스는 한국어와 영어 채널이 분리돼 유튜브로 생중계되고 있는데요. 컨퍼런스를 시청하시면서 궁금하신 점이나 질문이 있으신 분들은 채팅창을 통해서 질문해 주시면 감사하겠습니다. 그럼 잠시 후 개회식과 함께 컨퍼런스를 시작하겠습니다.
여기서 보이죠? 쓰고 있다고. 여기서 쓰니까 거기서 보이는 거.
네. 네, 여러분.
Good morning. I will be the MC of the GAIC Global Alternative Investment Conference 2021 today, and my name is Hyeon Park. This year's conference is the third of its kind, and I thank all of you for joining us today. The theme of GAIC 2021 is ESG in alternative investment. Experts in economy and investment are gathered in one place today to discuss changes and opportunities in alternative investment brought by ESG and relevant strategies. I hope you will stay until the end and gain a better understanding of ESG as a new alternative investment solution. Today's conference is being broadcast live on YouTube in English and Korean channels. As you watch us and come up with questions or comments, please leave them on the chat window. Now, let us begin the GAIC 2021 hosted by Edaily and KG Zero In with an opening speech from the chairman of KG Edaily, Kwak.
Hello, I am chairman of KG Group, Kwak Jae-sun. Edaily and KG Zero In are co-hosting today's Global Alternative Investment Conference for the third time this year. Building on the success of the second GAIC, we have come to meet you once again this year. Despite the unprecedented crisis brought on by COVID-19, you have given us overwhelming interest and support for our conference yet again. Thank you. With sluggish global economic growth and unfavorable investment landscape, the market is adversely affected by COVID-19 and subsequent uncertainties. When the going is strong in the investment landscape, investors can deliver performance irrespective of their ability, but when things start to turn sour, the difference between good and bad investment is bound to become all the more clear. With fundamental changes taking place in the investment landscape, alternative investing comes with both opportunities and risks at the same time. Flexible management of asset allocation strategies will determine the fate of investment. Against this backdrop, Edaily and KG Zero In seek to explore solutions at today's conference. In this complex, uncertain investment environment heavily shaped by COVID-19, we're looking to find knowledge and wisdom that will guide our way in difficult times. Domestic and foreign experts will be presenting their innovative investing techniques in promising fields, thus offering opportunities to create higher value in investment. This conference will be held in a hybrid format, overcoming the limitations of time and space as a custom-tailored forum for audience. Edaily and KG Zero In, as part of special sessions, have already held monthly webinars since April this year. Some 20 experts from home and abroad have taken part in these sessions so far to delve into the trends of global alternative investing and PE, hedge fund, real estate, and other areas in greater depth. GAIC 2021 will be drawing on the accumulated knowledge and wisdom to offer insights into future trends. It will provide useful opportunities to those overseas managers looking to enter or expand their positions in the domestic market, although we cannot meet in person this time. In the online space, key domestic investors will be having one-on-one meetings as part of practical and useful programs to help interested managers gain a foothold in the Korean market. In this contactless era, such programs, I hope, will link investors and managers as a pragmatic investment platform. Moving forward as well, our two companies will actively represent the voice of the market to contribute to the development in alternative investment and Korea capital market. I ask all of you for your continued strong interest and support for Edaily and KG Zero In. Thank you.
네.
Yes, recently there has been a growing interest in alternative investment, and GAIC 2021 is the third of its kind this year. We just heard from Chairman Kwak for opening remarks, and I would like to thank him for sharing his time. Next, we'll hear congratulatory remarks from CEO of the National Pension Service, NPS, for the success of GAIC 2021. He will join us in video. Greetings, I am Yong Kim, CEO of the National Pension Service NPS. I extend my sincere congratulations on KGE Edaily for hosting the Global Alternative Investment Conference 2021. I would also like to thank Chairman of KGE Edaily Kwak and CEO Ik-won Lee, among others, for inviting me to this meaningful occasion. My deepest appreciation goes to alternative investment experts from Korea and abroad who are here for presentations and discussions, as well as all other participants joining us online today. COVID-19 pandemic that began last year is still with us today after more than a full year, putting us through unprecedented transformations. While the stock market that had plunged right after the pandemic has quickly rebounded as governments around the world nimbly moved to adopt stimulus packages, an unprecedented level of liquidity supply to prop up the economies is widening gaps among industries. Despite the vaccine rollout, COVID-19 is spreading again, and amid the continued travel restrictions across borders, we're witnessing rapid political, social, and regional changes. Even with an array of policies for economic stability, inflation fears are deepening and investment uncertainties are rising, intensifying competition among global investors. As one of the key words most noted in today's fluctuating market, ESG, today's theme, is coming into a brighter limelight, coupled with a pandemic-induced sense of crisis as humanity, as well as low interest rate environment. Keeping a keen eye on rapidly changing investment paradigms, NPS is expanding its investment in alternative assets and taking note of ESG investment opportunities to attain strong, stable returns in the long run. The timberland investment NPS made for the first time earlier this year is not only an attractive investment from the perspective of sustainable investing, which is another emerging global trend, but also aligns well with the NPS philosophy of pursuing long-term, stable returns. We're interested in investing in infrastructure such as new renewable energy sectors and also following real estate market changes in office buildings and logistics centers, among others, where ESG values are being emphasized. Surely, based on a responsible investing policy, we will first implement an ESG investment strategy for equity and bond assets before gradually expanding it to alternative investment. While keeping close tabs on ESG, a new investment theme that is a factor that we must take into account for risk management, as governments are taking vigorous actions for carbon neutrality and announcing various regulatory changes such as ESG-related disclosure requirements, we plan to seize investment opportunities amid these changes and step up global alternative investment. Last year, in an effort to overcome physical restrictions in global deal sourcing and due diligence, and develop opportunities for joint investment in promising target assets, NPS has leveraged its strategic partnerships with leading global institutions and executed investments stably. This year, we're committed to proactively responding to changes in investment landscape by realigning our organization to pursue private debt or secondary strategies and more actively incubate new strategies tailored for alternative investment. Ladies and gentlemen, COVID-19 pandemic has unleashed historic levels of uncertainties. Yet, it is also offering new investment opportunities upon, for instance, emergence of new industries. ESG, right at the center of these transformations, is now being positioned as a driving force behind sustainable growth. As you examine ESG values and prepare new investment strategies in response to new post-COVID-19 paradigms, I hope today's conference will offer you a meaningful time. Once again, I would like to thank the presenters and all other participants for taking the time out of your busy schedules. Thank you.
네, 전 으로 인해서 정말
Yes. The world is having difficult times due to COVID-19, and it has had a huge impact on economy. Today, I hope that today's conference will give you an opportunity to gain a better understanding of what we face as a challenge in this difficult time. I would like to thank him once again for the congratulatory remark. Next, I would like to invite Mr. Seoungho Jin from the KIC.
안녕하세요.
Hello, I am Seoungho Jin, Chairman and CEO of Korea Investment Corporation. I offer my congratulations to the third Global Alternative Investment Conference and also my gratitude to Chairman Kwak of Edaily and other related officials for having me here. Distinguished investors, the COVID-19 virus sent massive shockwaves throughout the global financial market over a year and a half ago already. Thanks to each government's response and rising vaccination rate, the world seems to have passed the worst possible scenario of the pandemic-induced crisis. Yet in no time, variants have emerged to hold back the world economy. As you may be well aware, the widespread COVID-19 pandemic and rapid ensuing changes in the economic and social structures are creating the gigantic waves of transformation in the investment landscape as well. And at the forefront of such change is the growing trend towards ESG investing. ESG is becoming a new paradigm of businesses, and sustainable development is being adopted as a management goal for many companies, with many such examples to date. In the capital market as well, ESG investing is gathering greater impetus. The market views ESG not only from the point of assessing the public interest or reputation of any investment, but also from the point of making key investment decisions. As the theme of this conference suggests, the importance of ESG in alternative investment cannot be overlooked. That is why most alternative investors are working strenuously to improve their environment, social, and governance domains. Transparency and other related indicators have been developed, and at the same time, CO2 emissions mitigation, energy saving, contributions, and other aspects are being incorporated into ESG investing. As a matter of fact, in the early days of the outbreak, due to extreme market uncertainties and concerns over business recession, some predicted that discussions on ESG could take a back burner. However, as the virus swept across the entire world, rather, sustainability and resilience came to merit closer attention than ever before. A case in point is the statistics published by GSIA, Global Sustainable Investment Alliance, which state that the last year's world AUM for ESG investment stood at $35.3 trillion, or 15% growth from 2018. KIC, as a leading institutional investor of Korea, has been applying ESG principles to all asset classes and processes by introducing integrated ESG system earlier than others as part of our efforts to align our responsible investing policies with global standards. Back in 2019, in the Korean government's world first issuance of green and sustainability bond, KIC took part in the effort to execute diverse investments across environment or social projects. For alternative investment as well, we have put in place a system to check ESG elements rigorously, and for brokerage service as well, ESG policies, strategies, processes, and other factors are assessed in a multifaceted manner. Through this, alternative asset managers are strongly encouraged to align their asset classes or investment strategies with ESG principles. Through recent organizational restructuring, KIC established a dedicated ESG strategy team called Responsible Investing Team. The new team for responsible investment will be working as Korea's flagship sovereign wealth fund to deliver stable returns and preemptively manage risks while joining domestic and foreign investors in their pursuit for expanding ESG investment partnerships. KIC has already declared its support for TCFD and also joined OPSWF, which is One Planet Sovereign Wealth Funds, among other active efforts. However, we want to do more. KIC will be leading the initiative to drive ESG investment through promoting green partnership. To be more specific, green partnership will be drawing on the government's green bond funding to execute co-ESG investment. We will utilize this platform to build consensus on ESG investment together with investors from home and abroad and vigorously expand this drive. Moreover, a periodic seminar with Korean institutional investors called ESG Day will be facilitated even further with a view to working towards ESG growth in the local financial market continuously. Global investors, KIC's endeavors for driving ESG investing are ultimately aimed at ensuring mutual cooperation between investors and protecting the value of investment assets. Going forward as well, we will make effort to continuously expand ESG-driven responsible investment and work with investors to broaden our partnership from various perspectives. Lastly, I hope today's conference will serve as a meaningful opportunity to help us move beyond the current pandemic era towards sustainable growth and investment. Once again, I congratulate you on the opening of GAIC 2021. Thank you very much.
Thank you, Chairman Jin, for sharing your remarks despite your busy schedules. Let me briefly walk you through our program today. We will have presentations and discussions in 3 sessions, including the keynote session, and summarize our discussions today in the final wrap-up session. First up will be the president of AIF Institute, Melissa Waller, who will deliver opening remarks, followed by a keynote presentation on ESG investment global landscape by Professor Randolph Cohen of Harvard Business School. After the presentation, CEO of Korea Investment Management Hong-Le Cho will chair a discussion session with our keynote speaker, Professor Cohen. Next, in session 1 on ESG infra scoring system data policy, we will again have presentations and a panel discussion. We have various presentations ready in the afternoon session as well. In session 2 on ESG applications in HF and PEF, PDF and PCF, real estate infrastructure, we'll have 3 presentations and have a panel discussion with 5 experts. The final session of today will be a wrap-up session on the topic of discussion and policy proposal ESG in alternative investment. Now, let us begin our program in a more full-fledged manner. First up will be the president of AIF Institute, Melissa Waller, to be followed by a keynote presentation by Professor Cohen from Harvard Business School.
Greetings, everyone. This is Melissa Waller. So happy to join you all. And congratulations go out to our group there at GAIC on their 3rd forum. And very humbled to be in the company of our other keynote hosts and guests earlier. So thank you again. I want to spend a few moments just introducing you all to AIF Institute and AIF Global, since we wanted to talk a little bit about what's been on the minds of investors globally when they asked me to join you all. I wanted to give you some insights as well as introduce our academic keynote. So I will go ahead and share my screen to give you a flavor of things to come. So the team within the AIF Global and Institute Leadership Group, I have up there for you to see. We are honored to be led by our founder and CEO, Brant Mallard, who I believe you all have heard from previously. And our vision for the Institute Centers has been led by our Executive Director, Shamila Kassam, who we are really excited to have joining us from leaving her post as Deputy CIO of the Texas ERS system. And real honor, last but not least, Professor Sam Chung, who has joined us this year as the Asia Advisor and has been an essential part of all the programming throughout the centers and the connectivity with the Korean region. So a big welcome to him with the team as well. Just a few things about AIF Global and the Institute to set the stage. we wanted to make sure that you knew that throughout the pandemic, we've been hearing so many times about the resources that investors need globally. And we try to foster the exchange of those ideas, the best practices and information around asset owners globally. And so we have advisory boards that oversee over 18 trillion in investments coming together within these different venues to share these best practices, ideas, and research and information. We launched our Centers of Excellence this year, and I'll talk about those in just a moment to give you a little flavor. And part of the ESG focus for today's event is actually focus of one of our centers specifically. Those centers try to reach out to research around the globe and look at actionable areas of focus for all of our asset owners. And those are some of the areas that we try to look at in more depth to help them reach their objectives. We have about 500 of them each year participating. This was a record for us this year because of all of the pandemic connectivity that was such a need. I think a lot of them are probably engaging as well within this event and other events around the globe. This is just one area that they convene just to exchange all those ideas. This year's annual meeting for AIF, we were excited to have so many different regions represented. We definitely were excited to see them from all over the globe. 161 investors came together in January to start sharing all those pieces of coming out into the next year past the COVID in that first year. Just a quick snapshot of that meeting that we had from the annual meeting. And then it was a really exciting time for AIF Institute and Global, which many of you joined us for, was the Asian AIF Inaugural Forum that was held this year. We were honored to have a keynote fireside chat with the 76th United States Secretary of Treasury, Jack Lew, and also the CEO of Korea Investment Corporation, which was really excited to have him join us for that discussion in that fireside chat. We had academic presentations as well as regional conversations. We were really excited to bring together things ranging from portfolio construction through all the alternative asset classes, as well as focus areas from our centers and those things that focused on ESG specifically. And we started planning already for the 2022 forum, which we hope will be next year in person. Hopefully we can come see you all. Some of the things that we use as research and resources that you'll see highlights of what's on the investors' minds are around education through our academic labs. You'll see that we've got Randy Cohen joining us today, but we also had Andrew Lowe with us during the Asian Forum, and also Dave Robinson, Andrew Lowe, and Randy did a educational series at the annual meeting as well, which was nice. I've mentioned the centers, and these are the centers that have focused on research at each part of the globe and all these different focus areas. When we looked at what was on the investors' minds throughout the pandemic, there became this increase for ESG and sustainable investing information and knowledge. I think it was very timely with the remarks that we just heard from the opening keynotes around looking at ESG investing and how to solve for that this center focuses on research and up-and-coming information that's helpful to these different asset owners, as well as the Insurance Investing Center. This has been a really great area of expertise coming together, looking at the regulatory platform. We'll look at that in just a moment. And the Center for Private Capital Investing has just launched with our academic series as well. And the Financial Innovation Center is the latest and greatest information on what's going on in the center, from financial innovation around everything from digital assets and crypto all the way through innovative strategies within the portfolio. We were really excited to have the focus for ESG and sustainable investing looking at different integration methodologies. I think you'll hear a little bit more around this from Randy, but this has been a great area of expertise, sharing best practices around the globe. As different investors do it differently, we wanted to take a closer look at how those things work within the strategies of the portfolio, as well as their overlays. The ESG and data benchmarking overviews have been a real popular subject as well. I think that most investors are looking at the data to see where things can be shown, or they can look at their portfolios to see which things stand out to them as working and which things are not. And then obviously everyone has climate on their minds. The climate-focused risk perspectives have become really highlighted in the past years, just looking at what's happening around the globe. There's been a big emphasis on this by both LPs and GPs alike. So this is another continued area of focus for the Institute Center. And then just looking at different application of tools for ESG implementation and measurement, that's continued to be a big concern for investors around the globe. I think the biggest aha moment for most of us, as we've seen as ESG and sustainable investing has evolved, has been moving away from just products of ESG investing and processes to a more holistic approach around ESG as a whole, and this as a system. So we're looking at these things such as circular economy and all these areas of emphasis as an investor that we have an opportunity to take a closer look at. So the Center for ESG and Sustainable Investing will definitely be checking those items out this year. I mentioned the Center for Insurance Investing and the focus of education on the regulatory landscape and capital efficient structures. That's a big focus for us, as well as what's on the minds of those investors. Collaboration with the Center of ESG as it looks at the impacts to the insurance investment portfolios. And then showcasing innovative credit strategies has been a huge focus as well. This is something that's important to those investors. I mentioned the Center for Private Capital Investing launched with the academic series. We just heard from Professor Josh Lerner just a few weeks ago, and he did a wonderful launch program around SPACs. So if you haven't dived into those, you'll want to check that out. We also are looking at, like I mentioned, the innovative business models for investors and infrastructure investing evolution. Those things have been on the minds of all the investors around the globe, and we continue to monitor those and add them to the Center for Research. And then last but not least, the Center for Financial Innovation. We're going to be doing additional exploration of the education of digital assets and crypto, showcasing digital platforms and technology uses for investor portfolio management. That's a huge one. And then the innovation in investment strategies and structures. These are probably the top 3 areas of focus that investors have brought to us over the past few months. And a lot of these things we see ebbing and flowing through portfolios, but now we'll take a deeper dive into the research. And it's really appropriate as we have one of our academic members who'll be joining us in just a few moments, Professor Randolph Cohen, featured there in the screenshot, as he did an intro to the crypto exploration discussions that we've had. Another exciting place that the Institute plays, and I know all of you will want to pay special close attention to, is the National Institute for Public Finance. This is a way to look at the different ways that capital is deployed within the United States through the Treasury offices. This is a really special program for 4 days where we get the opportunity to bring investors and Treasury professionals and academics together to look at the most concrete examples of policy execution as well as alongside investment strategies and discuss those things in an academic setting. Just a quick glance at what's on deck for the rest of, for the rest of into next year. And you'll see that we have an ESG symposium coming up, very timely for this audience. So we'll make sure we get information back out to you for that as well. And last but not least, we brought together, for most of our forums, we love to weave in special academic keynote speakers and research. This is a special place that they can apply just the world of study and measurement and information to what we practice in our investment world every day. So it is my sincere honor and pleasure to introduce our academic keynote today. We have Randolph B. Cohen joining us. He prefers Randy, so I will call him Randy. He's from the MBA class of 1975, senior lecturer of entrepreneurial management at Harvard School, AB in mathematics from Harvard College, and doctorate in finance from the University of Chicago. He teaches finance and entrepreneurship at Harvard Business School and has previously held positions as associate professor there as well and visiting associate professor at MIT Sloan. He co-created the Alternative Investments course for Harvard Business School online, which is taken by thousands of students and professors each year. And he has helped to start and grow a number of businesses, mostly but not exclusively in the area of investment management, and has served as a consultant to many other companies. I must also say he is a proud member of the AIF Academic Board as well as the National Institute of Public Finance Boards, contributing his academic insights there as well. And co-founder of PEO Partners, an asset management firm which specializes in liquid private equity, a research interest of Randy's as well for over 20 years. So with that, I will turn things over for Randy.
Terrific. Thank you so much, Melissa. It's always great to hear your thoughts on all the things that are brewing at AIF. I've been with AIF's Academic Advisory Board since the very beginning, and it's been a fantastic experience. So I get the opportunity to talk to you guys a couple times today. I'm going to speak in a little bit. We'll be talking about ESG investing, and I'm excited about that topic. And then in the afternoon session, I'm going to have something to say about liquid private equity, which is a subject very dear to my heart. I've been developing a project in that space. I've been proselytizing for it literally for over 20 years, and we have something really exciting going, which I'm eager to tell you about later. So I thought for the keynote, I would stick to the very big picture question of why alternatives are so crucial today and sort of what we can do about it. How can we make the most of the opportunities that are in front of us today and avoid the challenges that we're facing? I just want to check, are my audio and video still fine? Okay, hopefully it's all okay. I haven't heard any objections, so I'm gonna assume you're all hearing me fine and seeing me fine. My screen looks a little odd, but I'm legally blind, so maybe I'm missing what's going on. So hopefully you can see me all right. Why are alternatives so crucial now? I have a new paper. In fact, I literally just wrote the first draft this weekend, so I'm quite excited about it. And we'll have a draft ready for circulation, hopefully in a month or so. And it's about the history of investing, and in particular, the classic 60-40 portfolio, 60% stocks, 40% bonds. Now, this is something that finance professors are rightly proud of because it was really developed by Harry Markowitz and William Sharpe, who developed modern portfolio theory and showed that the optimal portfolio to hold under general circumstances was the total market portfolio. And that what that basically looked like was 60-40, 60% stocks, 40% bonds. So how's it done? It's been about 60 years since they developed this idea. How's the performance been? The answer is it's been absolutely spectacular. We did the research to really work this out pretty carefully. And what's nice about it when speaking to this audience is that the 60-40 portfolio performance has been comparable, whether you look at the US data, which we Americans have a tendency to focus on, or the global data. The results are pretty similar. One thing that's really remarkable that I learned is despite the incredible performance of the stock market, and even specifically in the US where stocks have done so well over the last half century, the Sharpe ratio, the return to risk ratio of the 60-40 portfolio has actually been higher than the same ratio for stocks alone. So it just gives you an idea how well 60-40's done, that it's actually outperformed even the stock market on the traditional measure of return risk trade-off. And so what do those numbers look like? Well, again, I'm going to quote approximate numbers for US. The global numbers are similar, which is you've made about 9% a year invested 60-40 over the last 50 or 60 years. Now that is truly remarkable. 9% a year for a lifetime makes 1,000 times your money, right? I talked once to a teaching expert, and he told me that 5 years after taking a class, students only remember a single thing from the class, just one thing. And he said, so make sure you know what the one thing is that they'll remember. And so I've gone and asked my students when I meet them years later, what's the one thing you remember from my class? And the one thing they remember is the rule of 72, that basically 1% a year for 72 years doubles your money. And so therefore 9% for 8 years or 18% for 4 years, Any two numbers that approximately multiply to 72 doubles your money. And so when you make 9% a year for 80 years, since 9 times 80 is 720, you have 10 doublings, which is about 1,000 times your money, right? 1,024 times your money. And so that is just astonishing. But it's better than that. It's not just that the returns of 60/40 have been super high. It's that the risk has been super low. In the last 50 years, even with just the US, even without global diversification, there's only been 1 year where you would have taken a double-digit loss on the 60/40 portfolio. And that's because whenever stocks crashed, which, stocks have crashed a number of times in the last 50 years, but whenever the stocks crash, your bonds protect you. And so as a result, other than 2008, where we did have a double-digit loss on the 60/40, and even that one wasn't that terrible, no other year did we even lose more than 10% on the 60/40 portfolio. So it just tells you how terrific 60/40 has been to get 1,000 times your money without having any, with only one major loss, and even that one not that terribly painful. So that is phenomenal history. And in fact, people who are skeptical of alternatives will quote that history. They'll say, why would I bother with alternatives when I can just invest in 60/40 and do so well? And it's true. Backward looking, alternatives weren't really necessary to deliver great performance. Our parents and grandparents had a terrific investment experience as long as they were sophisticated enough to know to put a decent amount of their money in stocks as well as bonds. But I have bad news and I have good news. The bad news is that looking forward, what we can expect is very, very different from what we've seen historically. We aren't going to get anything remotely like 9% a year from 60/40. And moreover, the risk is not going to be as low as it's been historically. So that's the bad news. The good news is that by employing alternatives, we actually can deliver a portfolio that has those same high single-digit returns that our parents and grandparents got. And we can also deliver it with moderate risk, as we saw in 60/40 in the past. And the way I like to think of it is this. The people who put 60% of their money in stocks back in 1960 or 1970, those were very bold, sophisticated thinkers. Those were people who were looking at the cutting edge. They weren't doing what their parents and grandparents had done. They were saying, I need something new and fresh. The old way won't work, and we need to be more invested in stocks. And so similarly today, individuals and institutions need to recognize that if they just do what their parents and grandparents did 60/40, it's not going to work the same way. And that's a general rule of life. If something worked well in the past, it will probably continue to work, but not nearly as well because the markets will have caught up with it. And that's why we need alternative investments. Now, let me make the case to you that it really is going to be different in the future. We don't know what stocks will do in terms of performance, but we know actually, let me say it differently. We don't know anything about what the stock market will do tomorrow or next month or next year, but we know a surprisingly large amount about what both stocks and bonds will do over the next 30 years. Let's take bonds as the easier example. If the 30-year bond is paying about 2% as it is in the United States, then if you hold bond for 30 years, you will earn about 2%, right? That's, those are safe bonds, so they're not going to default, but you're only going to make 2% a year. Well, what about stocks? Well, with stocks, we have to be a little more sophisticated, but it's not too difficult. The return on a stock has two components. You get a dividend yield and you get growth, right? Now, if you look at the growth of the economy as a whole, in some sense, the growth of the stock market has to be similar. Earnings growth, profit, cash flow growth, sales growth, all those numbers have to grow more or less in proportion to the economy. Now, again, over any given 1 month or 1 quarter or 1 year, it can be pretty far out of whack. But over a generation, it really needs to be basically in line. So now if we look at what we can expect, well, the dividend yield of the stock market globally and in the US is in the neighborhood of 2%, okay? And the growth rate of the global economy is also in the neighborhood of 2%. Of course, a little faster coming out of COVID, but as a long run growth rate, we can expect about 2%. And then, of course, you have inflation as well. So essentially what you can realistically expect is something in the neighborhood of inflation plus 4 on a go-forward basis. And so if inflation is going to be 1 or 2%, and to be honest, growth rate of 2% is probably a little aggressive looking ahead. And frankly, the dividend yield is a little less than 2%. So you really have three numbers that are in the 1.5 to 2% range. If you add those three numbers together, you get 4.5 to 6%. 5% is probably a realistic estimate of the go-forward return of the stock market. Again, no idea what stocks will do next week, next month, or next year. But over 30 years, it's going to be around 5% a year. If the market is on a tear 30 years from now, and we're in boom times, you might get another 30% boost. But when you spread that out over 30 years, it just adds 1% a year. If the market crashes the day before the 30th anniversary of this speech, you might lose 30%, but that's only going to knock 1% a year off the numbers. So the upshot is stocks are going to make about 5, bonds are going to make about 2. The 60-40 portfolio is going to make between 3.5% and 4% a year. That's not 1,000 times your money over a lifetime. That is 10 times your money over a lifetime. So if we do what our parents and grandparents do, we're going to get a very different and hugely disappointing outcome. Okay, so that's the bad news. What's the good news? The good news is that there is a way to deliver those high single-digit returns with, oh, I'm sorry, I didn't finish the bad news. The other bad news is look at the risk. Can we look at stocks and bonds today and say, oh, there's no way that you're going to take a double-digit loss on the 60-40 portfolio? That's the furthest thing from the truth. If long bonds go from 2% yield to 3% yield, not to 7% yield, not to anything extreme, just going back to the kind of 3% yields that were common in the US and in many countries around the world, before COVID. If that happens, we're going to see bonds fall 30%. That's just bond math. If bond yields go up by 1%, the 30-year bond price goes down 30%, right? Multiplied by the duration. Okay, what about stocks? Well, we know what's going to happen to stocks. Stocks are going to lose 30 or 40% if the bond yield goes up that much. We saw the other side of it in COVID. We saw stocks run up 50% because of the Fed action in lowering those long-run interest rates. Stocks have very long duration, and so therefore it makes sense that they are going to be very sensitive to interest rate moves. So if interest rates go up, we are going to lose 1/3 of our money on the 60-40 portfolio. Again, it's only once even lost more than 10%, and that was like high teens loss. A 33% loss would be unprecedented and horrifying. And yet that is something that is an extremely realistic outcome. So when you look at 60-40, you're looking at future return expectations that are very modest and risk that is dramatically higher than what we've seen in the past. And this is all a consequence of how low rates have become. Now, I'm not here to tell you that rates are going to go way up. Hopefully they won't. I'm merely saying that it could happen. If there's too much inflation, central banks will be forced to act and raise rates, and we're going to see devastation in both stock and bond markets. As I said earlier, if your stocks crash, your bonds will protect you. But if your bonds crash, your stocks will not protect you. They're going to crash right alongside your bonds. So that's the bad news. Now, what's the good news? The good news is that we have a range of alternative assets that can deliver those high single-digit returns, and they can do it with moderate risk. Now, investment by investment, risk isn't going to be that low. That's not how alternatives work. They have significant risk in each individual investment. The key, though, is that because alternatives are also different from one another, we can use diversification to put a package of alternatives together that while the individual investments might be moderately risky, the package has low risk. And so we can deliver that low risk we used to get from 60-40, but won't anymore, with high expected returns. Okay, last thing I want to say is, how do we do it? How are we going to find alternative investments that deliver that strong performance but aren't too risky? I have a theory on this, and I think it really is the right way to think about the problem. Consider a spectrum from, on the one end of the spectrum, very traditional assets that have strategies that have been proven for decades to work, okay? And at the other end of the spectrum, consider the newest, most exciting ideas that are very unproven but have very high potential. Now, if you invest, we already talked about the traditional approach. If you invest, let's take merger arbitrage, right? A well-established traditional alternative strategy. It's worked for a long time, and you know what? It still works, and it'll work for the next decade, but it won't work nearly as well as it used to work. Convertible arbitrage, volatility trading, all these basic time-tested strategies, they will continue to work, but the edge is not what it used to be. And that's why the average hedge fund does not perform nearly as well as it used to, because these strategies are much more competitive now, and a lot of the edge has been squeezed out. So you don't want to be too much at that end of the spectrum. Not to say you shouldn't have anything in those traditional approaches, but you can't overweight those traditional approaches because they're not going to work as well as they used to. What about the other end of the spectrum? What about the most exciting new approaches? Well, first of all, what are those? We may all have varying opinions, but I think we would all agree that there are some very exciting things going on in cryptocurrency, and there are very exciting strategies related to machine learning and artificial intelligence. Now, the problem is those strategies may not be fully ripe yet. That is to say, there is enormous risk and uncertainty, and very, very few people have a proven track record of being really good at investing in those areas. So should you experiment in those areas? Should you dip a toe? Absolutely, it's appropriate to look at those and consider experimentation. But you don't want your portfolio dominated by areas in these new, highly uncertain, but very exciting areas. You want to watch them closely, maybe do small investments to learn about those spaces and be ready to pounce as they move into that center zone of things that have established their bona fides, right? So what's in the center zone, right? Whenever somebody shows you a spectrum with extreme at one end and extreme at the other, they're probably trying to convince you that the center is the place to be, and this is no exception. So what do I think is the center? Where do I think are the most exciting alternative investment possibilities where they've proven their mettle, but they still have lots of juice left in them? And what I would say is these are traditional strategies that you can access in new ways, right? And so probably one of the most exciting is private credit, right? It used to be that it was banks that made loans to small businesses, to consumers, to others. And the problem is, sure, you could buy stock in a bank and then you would get the performance of the bank stock, but that is a very costly and inefficient way to get access to the benefits of small business, of high yielding small business lending and private credit. Nowadays, there are many ways to invest directly in platforms that will give you access to making those loans for those very high yields. I work with companies that give really almost quite spectacular performance, way into the double digits in terms of the kind of private credit opportunities they're seeing, and that area is just expanding every year. So what we've done is to disintermediate the banks and say, you know what, the banks were taking too much of the opportunity in private credit. Let's find more direct ways of getting those investments done. And that is a really exciting alternative area. A second is disintermediation of insurance companies, right? We now have opportunities. It used to be that if you wanted to do reinsurance investing, all you could really do is buy stock in a reinsurance company. Now there are funds where you can directly invest in those reinsurance deals. They're highly diversified. They crash of course, if you issue hurricane insurance and a hurricane hits, you may take losses, but you will not take losses at the same time that the market is crashing. So it's a diversifier, and you can have hurricane in Florida, and you can have earthquakes in San Francisco or Tokyo, and you can have typhoons in the Pacific Islands, and these are all uncorrelated with one another. So there are ways of capturing premium without taking on a lot of correlated risk. Right. A third example is trading. And that is to say, it used to be that all the juicy trading opportunities were locked up within big investment bank trading desks. And they made enormous profits on their prop trading desks. But now more and more of those opportunities are spun out into funds where those middlemen who say, you know what, I'm not going to guess which bonds are going to go up and which ones are going to go down, or which currencies are going to go up or down. I'm just going to buy for 99 1/4 and sell for 99 3/4 and make that $0.50, and I'm going to make that $0.50 day after day after day. Those are very profitable, low risk strategies, and now some of them are accessible outside of just, again, buying stock in JP Morgan or Deutsche Bank or something. And then there's one more I want to mention, and that is related to liquid private equity. And that I'm going to stop here because I'll be speaking about this in the afternoon session. But again, I think there's a huge opportunity to take a strategy that is known to work. We know small business lending makes money. We know reinsurance makes money. We know proprietary trading makes money, and we know private equity makes money. And the question is, are there newer, more efficient ways to access some of those premium? And I think there are. And so I've mentioned some. And then in the afternoon session, I'll get into liquid private equity and tell you in detail what I've been saying in that area and what we've been building. So that's all I have for right now. I think it's going to be a fantastic day. So thanks so much for having me.
Yes, thank you very much. I would like to thank once again President Waller and Professor Cohen for your participation. Now, I would like to invite CEO Cho of the Korea Investment Management so that we can have a discussion session with the keynote speaker, Professor Cohen. Yes, good morning. First of all, on behalf of the participants of the GAIC 2021, I would like to extend my appreciation to our keynote speaker, Professor Cohen. You've spoken about this important topic for about 20 minutes, and in order to see more advancement in the ESG investment in Korea, I believe that your insights will be a great help going forward. During the past 2 to 3 years, in Korea, ESG investment has seen dramatic growth. And maybe that is something that you can reference. For instance, in the public market in Korea, the size of ESG investment has almost grown 10 times over the past 2 to 3 years. And for the sake of this discussion session, I've come up with 2 to 3 questions that I believe are of great importance. And we are connected online with the floor. And if we receive any questions from the participants, then I will relay them to you. First, let me ask the first question. For a more accurate understanding on your part, I would like to ask this question in English.
And I understand you are an expert in private equity investment, and specifically, you are specializing in the liquidifying the illiquid investment in the private equity area. And with respect to the ESG investment, my question is it facilitating the liquidifying process, or is it a kind of obstacle to the process? That is the question. You have 4 or 5 minutes for this question.
Yeah, so
Yes, 유동적인 PE는
speak. This is tricky. Okay, I'll do my best. So liquid private equity involves taking the things that private equity does that make it so successful in generating great performance for investors and finding ways to implement it in liquid investments, which is to say in public companies. So the idea is that, and again, I'll get into this in more detail later in the afternoon session, but big picture, just so we know that we're on the same page. Liquid private equity means this. We have the data on the holdings of all of the thousands of private equity firms out there, right? We've been working primarily with the US private equity firms, but we're working towards creating global portfolios as well. And so, for example, in the US, there are 1,100 firms doing leverage buyouts. And among them, they hold about 10,000 private companies. So what we do is we say, okay, there's 10,000 companies. Let's get the data on what those companies look like. Let's understand their characteristics. And then let's buy a portfolio of public companies that match the characteristics of those private companies. And that way you can capture most of the edge that private equity delivers by being in the right industries and the right kinds of company. And private equity does an exceptional job at being in the right industries and the right kinds of companies. And we can match that within a portfolio of public companies. Now, when you look at ESG, you can see that liquid private equity is hugely advantaged for doing ESG, because with ESG, you have an enormous number of public companies, and you have a tremendous amount of data on who is doing what in the ESG area. So for famously, MSCI, of course, has a data set where they rate companies on the various elements of environmental, ethical, social governance, and so forth. But there are many other companies doing these ratings, and as a result, because you have so much information about these companies, it's entirely doable to create an ESG portfolio that matches any particular set of needs. And that's something that's going to be very difficult for private equity to do, traditional private equity. In other words, if you are a traditional private equity firm and you have a customer who has particular ESG concerns, you're not going to be able to make a fund for just that customer. You're going to have to make a fund that just says, well, we care about ESG in a broad sort of way. We'll try to invest in good companies. But here's the problem. It is not at all clear what ESG means. And this is something I think you'll spend a lot of time on across this entire panel discussion, I think, as other subjects come up. Let me give you a simple example. When I was a young professor, I used to go every year and teach a seminar for young executives of Lockheed Martin Corporation, which, as many of you know, is one of the world's largest defense contractors. And so they make airplanes and weapon systems for the U.S. military and for militaries all around the world. And these people were at this summer session because they were kind of the top young engineers and executives at the company who are on their way climbing the ladder to be top executives as they got older. And so I got to spend a lot of time with these very smart, very energetic young people, and I would teach them introductory finance, and I would learn about the projects they were working on. And so I walked away with a very positive impression of these people and their firm. And my view was, okay, I get to sleep safe in my bed at night, even though personally I'm not in the military, I'm blind, I'm not going to be a person who's going to go on the front lines and fight. But because the people at this company are creating these various defense weapons to help protect my country, and I think probably to help protect South Korea as well, that this is a good thing. However, I know plenty of people who have exactly the opposite view of defense contractors like Lockheed Martin. Their view is these people make the bombs and bullets that kill people. They are exactly the people you would never want to be invested in. And so what I'd say is neither of the side in that debate is crazy, right? It's not crazy to think the defense contractors are good guys, and it's not crazy to think that they are people that you would want to avoid being invested in. And so, with maybe a couple of rare exceptions, a lot of companies are in a gray area where some people might say, oh my gosh, this is a wonderful healthcare company. And other people might say, oh, my religion says that contraception is a sin, and this company helps people, avoid unplanned pregnancies. And so this is a terrible company that we would never want to invest in. So what I think is so great about liquid private equity is its extreme flexibility. We can make a custom liquid private equity portfolio that meets any set of ESG needs that are the specific needs of a particular investor, as opposed to broadly saying, oh, well, we think this is a positive ESG company, which I think is not something that I think is nearly as helpful to anybody in achieving their ESG goals.
Okay, thank you. Thank you for your answer. And we are going to the second question. Yes, you are an expert in the private equity fund, and by its definition, the private equity investment is directly related with the governance issues in many cases. So my question is, can you identify several patterns where we can witness the governance improvement from your own experience?
So first, let me just say a quick word about the cleverness of ESG terminology. And I'm a big supporter of ESG investing. I think it's really important that we use our money to do as much good as we can for the world, as well as, of course, growing it for the benefit of plan participants in pension plans, beneficiaries of endowments and foundations, corporate sponsors, and so on and so forth. That said, there's an interesting element here in terms of the idea of governance. So it's not obvious what governance means, right? One way of looking at governance, so consider an issue of wages for workers and negotiations with labor unions, right? So one way of looking at governance is good governance means that you maximize shareholder value. And maximizing shareholder value means being very tough in negotiations with the workers and with the labor unions, right? And that's not a crazy definition of governance. In fact, before the term ESG became popular, if you'd asked me 20 years ago, what good governance meant to most corporations, I would have said something like that, right? That it meant that you are focused on maximizing shareholder wealth, okay? On the other hand, other people would argue in an ESG context, what good governance means is that you bring all stakeholders into the process. So not only do you think about shareholders, but you think about employees, you think about retirees, you think about bondholders, you think about the taxpayers, the environment, and all the other related stakeholders. That's what good governance is all about. But you can see that these two definitions are kind of opposite from one another. And so, so what's clever about the ESG framing is it kind of enables people to view it positively, even though they may have different views. People kind of get to see what they want to see in terms of that. Now, when we turn to private equity, look, I have been sending my very best students off to private equity firms for 25 years, and they do a fantastic job. I have been super impressed with them. These are extremely talented and hardworking people. And when they take over companies, they make those companies much better. They really do a great job of it. And so how do they make them better? Well, sometimes it's as simple as just implementing best practices. You know, often they're taking over a company that was run by the founders of the company. They've been running the company for 30 years. Now they're in their 60s. They're very smart. They know their business well. But at the same time, there may be technologies that they haven't learned about. You know, they're older. We all know as we get older, we're less likely than our kids to go learn about the latest cool technologies. And so, you know, there may be best business practices that, you know, just weren't known at the time when they went to business school 35 years ago, the founders, that is, and now are known. And the founders just, you know, they haven't necessarily kept up with all that. So that's one area. So just implementation of best practices. Another big area is that private equity firms often do a great job doing roll-ups. They'll see a space where, so I'll tell you a great story. I had a group of students who were buying up veterinary clinics, right? So animal health. And so they would go and identify veterinarians who were close to retirement. And what they found in the United States, almost 90% of young veterinarians are women. And a lot of those women had a lot of responsibilities at home in terms of raising children and so forth. And then they had a full-time job as a veterinarian taking care of animals. And then the idea of buying into the practice, buying the company from the older veterinarian was like, wait a minute, now I have to go $1 million into debt, and I have to run a business, and I have to take care of all the animals, and then I have to go home and take care of my home and children. It's just too much. I don't want to buy the business. I just want a job where I get paid and to do the stuff at home. And so what they found was that these folks who were retiring couldn't get very much money selling their businesses. So they were able to buy these companies at like 4 times earnings. And then once they bought like 20 of these veterinary clinics, they put them all under one banner, changed the name, they got volume discounts, and they were able to sell for maybe 10 or 12 times earnings instead of 4 or 5 times earnings, because now they had a big company that could be sold to an even bigger company, and they were delivering phenomenal returns for their investors. So that kind of roll-up strategy can be very powerful. And then a third powerful thing that PE firms do to improve the companies is they just will find a great local or regional company and take it national or global, right? So they'll say, well, this company is doing an amazing job selling in the Pacific Northwest. The founders are too far along in their careers to want to go and make that a national firm or a global firm. But hey, we here at the private equity firm, we have the energy to do that. And that's another area where they're able to make huge value-adding improvements.
Thank you. Thank you for your answer. And your answer sounds like that the governance issue, even within the private equity investment area, governance issue cannot be 100% separated from the social issues, and those two issues could be linked in somewhere. And okay, so let us check if there are any questions from the participants who are connected online. And during the meanwhile, I'll ask a third question. Let's focus on the environmental issues of ESG investment. And my focal point is that renewable energy and carbon emission right or carbon reduction. So my first question, my sub-question is, can you give us any short experience or anecdotal cases regarding this area? And the second sub-question is, we do have, back in Korea, we do have a little controversy about the use of the nuclear power plant with respect to the carbon reduction or other related environmental issues. So can you just shed some light on these issues from your own opinion?
Yes, absolutely. I think, look, climate change is the crisis of our times. I would have said the same 10 years ago or 5 years ago, and I think a lot of people would not have taken it so seriously. But I do hope that the events of the last couple of years, where we are just seeing an unbelievable growth in the number of giant storms, in wildfires all around the world, in heat waves, I think people have to recognize, there was sort of a strategic mistake made in the term global warming, right? Being warm sounds like a nice thing. It's warm and cozy. What people fail to recognize, and the term climate change, I think, does capture it better, is that, different places, every place where there are lots of people has nice weather, or people wouldn't live there, nice in some sense. But if places have different weather than what they used to have, then their systems just aren't built there to handle the new weather patterns. And so places that aren't used to getting massive amounts of rain suddenly have them, and now you have flooding and huge destruction. Or places that are used to having a temperature that is good for skiing suddenly, or for growing grapes. Suddenly you can't do those things anymore because the temperatures and humidity is not right, and the economy gets destroyed. So the issue is absolutely paramount in seriousness. And my view of nuclear power is that it is absolutely a part of the solution to climate change. Of course, we all look towards a future where 100% of our power comes from carbon-free alternative, renewables. And I do think that we're making really rapid progress in terms of the technology to where now in many places solar and wind power are the lowest cost new sources of power. And I think that is a phenomenal change. But we are certainly not yet at a point where we can power the entire world with renewables. And so to the extent that we can use nuclear, every kilowatt hour produced by nuclear is one less that we need to have produced by coal or natural gas, which are pumping so much dangerous carbon into the atmosphere. Now, obviously, there are risks associated with nuclear power plants. And yet, I think, the history has been really spectacularly good for nuclear power plants in terms of, not killing people. And certainly if you compare to the incredible, even if you ignore climate, coal and natural gas and oil power, they kill millions of people a year just through pollution. And so my own view is that we should be very supportive of nuclear power with an understanding that the long run goal is to that the long-term goal is to move as rapidly as possible towards renewables. But still, while we're in this phase where we're building out the renewables, I think nuclear can be a big help. Now, in terms of the environmental issues more generally, look, I think that I think there is a real challenge for ESG investors on this issue. In other words, if let's say we have a group of people who really are concerned about climate change and really recognize the seriousness of that issue, and they want to fix it. The obvious thing for those people to do is to say, okay, we're selling all of our stock in companies that invest in that are doing coal and oil and natural gas, right? And that is satisfying in the sense that you feel like, okay, my hands are clean. I no longer have anything to do with these companies that are destroying the world. But the problem is if everybody who's concerned about the climate sells out of their stock in those companies, then 100% of the shares of those companies will be held by people who don't care about the climate, just by definition from what I said. And then those companies are going to be very unlikely to do anything to try to improve climate change. So I want to suggest that people need to think very carefully about the trade-off here, because it may be that there is more to be gained from engagement with those companies than from divestiture. And so if I were to say, where the benefits are for ESG investing, the number one thing would be to use ESG investment dollars to help companies with breakthrough technologies that can make a difference, and to support those companies and invest in them. And then to the extent that we think about, okay, sure, fine, but we can only put so much money into those companies, we need to be more diversified. What about the rest of our money? I would definitely consider the possibility that engagement may be more beneficial for interaction with the problem companies than divestiture. If you own shares in Royal Dutch Shell, then maybe you can influence them to do more to make the planet green. And if you don't own shares, you've got no say. And when you ask yourself, what's the benefit of divestiture? It's pretty hard to make the case. I actually have a little paper I'm working on in this area. What it shows is if half of all the money in the world decided to divest completely from all fossil fuel companies, not if they all did it on one day, but if they did it slowly over the course of a few years, which is more realistic, the change in the expected return of those companies would be just a handful of basis points. It would have almost no impact on the prices or expected returns of those companies or on their behavior. So while there's a notion of, we'll hit them where they live by selling their stock and affecting their stock price, it just turns out the stock price won't be very affected. And so that's why I would look to these other solutions.
Okay, thank you. Let me check if we have questions from the participants connected online. 지금 온라인 질문.
So are there any questions from our online participants? I don't think there are any special questions coming here.
There is no specific questions from the participants probably because your speech and answers are so comprehensive. So so let me wrap up this session. And again, on behalf of all the participants, we thank you very much for your speech and your answers. Thank you.
Thank you so
이걸로
much. This has
세션을
been a pleasure.
마무리하도록 하겠습니다.
We're going to wrap up our session now. Thank you very much.
토론을
Yes, I would like to thank both gentlemen for sharing their insights. Next, let us move on to the next session. Session 1 will address the topic of ESG infra scoring system, data, and policy. First presenter will be Mr. Sam Jun, professor of Yonsei University and the president of the Korea Alternative Investment Research Institute. Let us hear from Professor Chung.
네, 안녕하세요. 정삼.
Good morning. My name is Sam Chung. It's nice to meet you all today. I have about 20 minutes with me today, and I don't think I will be able to cover the entire presentation slides that I have prepared. So the title of my presentation today is Alternative Investment and ESG on the Way to Becoming the Normality. How is ESG being applied to the alternative investment market is what I'm going to talk about today. ESG is now becoming sort of an standard investment method in the market, and I would like to examine whether we are taking the right approach. And if time permits, I would like to spend some time to talk about ESG scoring system. To talk about ESG scoring system, and not just in Korea, but also in the global markets. The focus is placed on the public market. So what we do is to base our decision making on the public information that's available in the market, such as disclosure requirements and so forth. So it was difficult for me to try to exactly pinpoint some data on ESG scoring system. So I will try to make some suggestions in this regard myself. In talking about the landscape of ESG investment in alternative investment, if you look at this slide, it's quite confusing.
The graph and map. 여기 먼저 그렇기 때문에 I want to define the acronym of ESG first. And I believe it is very broad and it's almost impossible to define what is the ESG. ESG means different for different people, different organization with different purpose. 여기 지금 제가 보여드리고 있는 거는 UN이
So this is the official definition announced by the UN for their responsible investing principles. There is an ESG strategy and there is SLI. ESG strategy, according to the UNPRI, is the consideration of non-financial factors.
investment decision making process. 라고 정의를 했어요. Non-financial factor하고 financial factor가 결합되는 게 ESG strategy라고 정의를 해놨고 SRI는 또 뭐라고 정의를 해놨냐? Only the financial return from an investment, but also the impact on investment, ethics or social change. 같은 내용이에요. 뭐가 다른 점이 있는지 전 모르겠어요. 여러분들도 아마 헷갈릴 거예요. 그래놓고 그 다음 단계에서는 두 개가 결합.
So I'm sure that you're quite confused about this.
Sustainable investment.
And then it also talks about sustainability investment, sustainable finance, sustainable management, and investment. How are these different? I tried to make a conclusion. In my opinion, all these three concepts are exactly the same. It's just that the terms are used differently depending on institutions, whether it's the government or pension funds or asset managers or retail investors. So to all these different people, they might use different terms. What about blended finance? It's based on quantitative and qualitative data, and they should be combined in order to create value data. I believe that that is aligned with the Sustainable Development Goals of the United Nations. So the reason that I showed you this presentation slide is because I wanted you to gain a clear understanding of what these concepts mean. Globally, we are seeing the emergence of a range of regulations and codes. There are different terms used here as well. But let me talk about some historically important turning points or events. The first ESG index, ESG scoring index, was created by MSCI in 1990. So it's been already 30 years. This is not something that has been newly coined or created. Of course, we're seeing a trend of ESG investment only in recent years. However, it's been already 30 years since MSCI came up with this sort of ESG index. And these days, we talk about UNPRI, and it's been about 15 years since the UN came up with this principle. It was created in 2006, and hundreds of institutions have joined this, including the ones in Korea. For instance, in the case of the Paris Agreement, it was signed in 2015. We often talk about climate change risk, and it's becoming a hot topic in the global financial market. But it's been only about 6 years since the agreement was signed. But even then, the ESG-related investment is experiencing an explosive growth. The number of PRI signing institutions is shown on this slide, and there could be various strategies that you can pursue. If you look at this on the right, there's negative screening, and another strategy is integration strategy. And more recently, we're talking about impact investing or positive screening. They're on the rise. Investment related to ESG, if you think of the global market and compare the US and Europe, the European investors are taking a huge lead, especially all the way until the Biden administration's inauguration. The AUM under ESG investment was 1/5 of the comparable figure in Europe. But after President Biden came into office, about $4 trillion investment driven by ESG is being promised, and there's a constant flow of good news related to ESG investment. So in the years ahead, I believe that there will be an increase in ESG investment in the U.S. But at the same time, what I'm talking about now is ESG fund or ESG-related equity funds or bond funds that are available in the public market. Then why ESG now? Professor Randy Cohen talked about climate change and climate change risk. And CEO Cho posed a very impressive question at the end related to nuclear power plants. He asked for Professor Cohen's opinion on the use of nuclear power plants. And of course, that there's a trade-off. Global warming and climate change will be a relevant factor in considering the use of nuclear power plants. And if you think of ESG, the first letter in there is E, environmental issues. Biodiversity loss is one environmental factor that you need to consider, weather patterns and so forth. All these environmental issues are becoming more serious, and everyone is starting to recognize the seriousness of these environmental matters. And it is almost inevitable for the U.S. to start to take a greater interest in ESG investment. Next. As I just told you, the ESG that I talked about up until now is focused on traditional ESG assets. So these are the assets with high liquidity in public equity or bond markets.
Are also appropriate. Embedded with the alternative asset class. 대체 투자 시장에서 ESG를 강조하고.
So in more recent years, there is a growing trend to consider ESG factors in making alternative investments. To think of why, I believe that there are two contributing factors to that trend. First, the big money or the big hands in the investment market, they are increasing their asset allocation to alternative assets. So they are considering alternative investment as something that they must do. As we try to sail in the vast ocean of ESG investment, and now we are realizing that just doing it in the public market is not enough now. The second contributing factor is as follows. We try to examine this trend in more detail, and we realize that the alternative market traditionally has been regarded as a market that is disadvantageous in terms of liquidity because it's considered illiquid. But if you think of alternative assets, the investment horizon is long. But in the case of the private equity funds, it takes about 7 to 10 years. And during that duration of investment, to think of the probability of ESG risks appearing, the need for risk management could be pretty substantial. Accordingly, ESG risks would increase, and for each asset class and product, different ESG risks would have to be addressed. Upon that recognition in recent years and months, even for alternative investment, ESG is becoming the focus of our attention. And asset managers are trying to take this factor into consideration when making investment decisions. As was mentioned by Professor Cohen, why do we have to deal with ESG investment in alternative assets or alternative investment? In the year 2020, starting from the end of 2019 until the end of 2020, the left-hand graph represents volatility, implied volatility. It peaked in last March, and it's down now. However, currently, it's hovering around 35 to 40. This will continue for the time being. Of course, vaccination rollout will be a factor going forward, and how it will produce tangible outcomes in terms of the number of people vaccinated. The volatility level will be affected, but most of the experts in the market agree that this volatility will not go away easily. This serious level of volatility in the stock market will stay with us for the time being. If that is the case, then we need to diversify our investment. Dr. Cohen talked about diversification in the sense of replicating a model portfolio, but look at this graph on the right hand. Starting from the 1960s all the way until the 80s, if you look at inflation trend, it's called a great inflation period. How on earth were we able to have this trend? For about 10 years, as you can see here. Actually, last year and this year, the accommodative fiscal policy has been adopted by the U.S. government and other governments, and the market liquidity supply is double the size of the liquidity supply right after the war. The history is bound to repeat itself, right? So if you look at this graph, then it is inevitable for us to have some concerns. We're not talking about 10 years or 20 years down the road. People are saying that tapering will start sometime within the year, and the rate has already been hiked in Korea. And in emerging markets, they are committing to raise their rates one by one. Then what do we have to do? We need to hedge ourselves against the inflation. Then which asset class do we need to invest in for that purpose? If this is the case, we have to diversify our investment in equity and bond, probably according to a model portfolio theory of 60 to 40, but that effect is disappearing now. Japan, Germany, and U.S. graphs are shown here in terms of correlation of their stock markets. 30 to 40 years ago, the correlation that existed among these three markets is now disappearing. It's becoming irrelevant. The negative correlation is maintained only with the U.S. market. U.S. Treasury and U.S. stock markets are maintaining a correlation of 0.4%, but in the EU and Japan, they're being coupled. Then in this case, under these circumstances, don't we have to add alternative investment assets to our portfolio? In 2021, this is definitely a trend that we need to take note of. And in this respect, ESG is definitely something that we need to take into account. Up until now, in my presentation, Mostly ESG was considered in bank loans, equity markets, and bond market. As you can see in this table, when it comes to alternative investments, green REIT products have been quite popular in Korea. In the case of the real estate investment, green buildings are one of the assets that you are considering. Easiest asset management building is, for instance, certified as a green building. That is to say, an eco-friendly building, and REIT's product portfolio can consist of those green buildings. Or if you make a venture capital investment, you will probably consider the green nature of the venture capital holdings. So these were the types of investment that were made in alternative investment space that considered the ESG elements: private lending, private direct lending, or hedge funds. In these cases, it was hard for me to find a case. I conducted a research personally myself, and I'm showing you 4 companies, and I've made calls to 2 of these companies, and I conducted phone interviews with the other 2 companies. The Sustainable Real Estate company, CBRE, is that company that provides consulting on real estate, which is a large company that has offices in New York, London, and Seoul. This company, CBIS, is saying that to them, ESG is an integrated ESG system. And applying the integrated ESG system is something that they believe will save cost and avoid regulatory risks in the real estate sector.
The CBRE environmental policy implementation and performance is overseen by our Responsible Property Investment Committee. CBRE는 사내 responsible.
So inside the company, CBIS has a responsible investment committee through which they represent real estate holdings that represent ESG friendliness. Outside consultants, environmental consultants, as well as governance-related consultants, and other types of experts will take part in the committee. Property manager will take part, suppliers will take part in the committee. What is more interesting to me was that the founding members of CBIS were the members of the company were the founding members of the Global Sustainability Real Estate Index. The benchmark index in the real estate market, GRESB, was promoted by a member from this company. They are still active in the committee of that index. And the GRESB is being applied to decision-making process of this company. Secondly, another company that I would like to address today is related to infrastructure, Aviva, with a headquarters in London. What do they do?
All infrastructure projects that are being considered for either debt or equity financing are subject to the ESG due diligence process. 재밌는 케이스가 있어요, 얘네들이. infrastructure 하면
When it comes to infrastructure, we talk about road construction, tunnel construction, and laying bridges. But environmental elements or environmental factors such as biodiversity impact are being considered. Climate issues, labor rights, and safety issues are actually seriously integrated into the system of making investment by this company. And they will be making investment only those projects that have been confirmed to be friendly in terms of all these factors. One more company that I would like to talk about today is a private capital, private debt company, which is called Creston Capital, which has an office in Boston and New York. They also told me an interesting story. They told me that their business strategy includes very illiquid and untransparent elements of making investment, and to gain proper returns for the risk premiums they are taking on, they need a much greater level of efforts and expertise in these assets. And to them, they told me that cost was the biggest factor, but after some time, they are saying that giving such great consideration to the cost factor is proving beneficial to them. Now let me talk about the hedge fund industry. ESG factors are not really fully considered in the hedge fund industry as of now, but one of the leading players in this space is a British company that you see on the slide. And this company is telling me that when it comes to stock picking or sector allocation, they consider ESG to a great extent. And I believe that I had a discussion with this company as to the benefits that they can gain out of considering ESG factors. First of all, they have great top talent working for their firms, and also, compared to other alternative investment managers, management flexibility is at a higher level at hedge funds, and governance can be a big factor to them. Hedge fund activism is a term that is used in the financial industry, and hedge funds can play a huge role in promoting the right governance in the companies that they make investment in. It was the same with Elliott case, Elliott Asset Management. And likewise, this company told me that they are trying to take a lead in promoting ESG investment in hedge fund industry. I believe that it's about time for me to wrap up my presentation. If you look at the current trends in the market, they can be summarized into two trends that are dominant in alternative investment. First is digital transformation. The other is ESG. When it comes to digital transformation, we talk about the fourth revolution, artificial intelligence, and big data. Of course, the fintech industry will be included, and there's a huge wave of investment centering around these digital transformations. Another huge wave in the investment market is ESG investment, and I hope that this is not just a gust in the wind. I don't see this stopping at just being a passing trend. Some people say that ESG investment is creating bubbles because everyone is literally talking about ESG-driven or ESG-oriented investment. But just because everyone is talking about it doesn't mean that they are wrong. This is a global trend that is evident, not just in Korea, but also in the US and in Europe. Then what kind of data do we need to apply? Then what kind of strategies do we need to pursue in making ESG investment? When it comes to these details of ESG investment, people have different opinions, which means that there's no one centralized theory in this space, not just in the public market, but also in the other private equity private market. With that, I would like to conclude my presentation, and the rest of it I hope we'll have a chance to discuss in the wrap-up session.
아쉽습니다.
I hope that you had more time, Professor Chung, but I am sure that your presentation was very helpful to many of the participants. Now, let me invite the next presenter.
용 전무의
Next is Mr. Andrew Ang from BlackRock, Managing Director. We have a video presentation by Mr. Andrew Ang.
Hello. Thank you very much for having me. So I would like to talk about finding alpha through ESG methods. Along the way, I will reference a paper that has a link in the presentation, and we can also follow up with you to send this paper. So my talk is entitled Finding Alpha in ESG Strategies. So let me share a presentation. Factors are broad and persistent sources of return, and they're very old. The first formal academic work on factors dates back to the 1920s with a book by Graham and Dodd called Security Analysis. And to find underpriced companies or companies with high quality earnings, they recommend using data from financial statements. I'm going to show you that these concepts of finding value and finding high quality companies actually haven't changed at all. We still live in cities, but the way that we build our cities and the way that we live our lives has evolved. We can move beyond earnings and balance sheet information to incorporate ESG information to help us add alpha. I admit that it's taken us a few years to think of ESG as an alpha return driver. And I want to share a little bit of the work that we did to think about how we can use ESG data in portfolios. If we think about all of these factors, they result from an economic rationale. It comes about through rewarded risk, structural impediments, or behavioral biases. For example, if we think about value, which has suffered over the last couple of years, we receive a risk premium precisely for enduring short-term losses, and we are compensated with long-term rewards. Value might also result from behavioral biases where growth companies are bid up aggressively, which has happened over the last couple of months. ESG data can actually have the same economic rationales. If we look at E, or environment, then whether or not a carbon tax is imposed, or whether or not some restrictions that are environmentally friendly are imposed, is a form of a structural impediment. We think about investor behavioral biases, but we also might think about behavioral biases of managers and employees, regulators, and other market participants. And finally, G, or governance. If we do this correctly, then actually G done right serves to reduce risk. We can align shareholders and manager incentives more precisely. We can eliminate rent skimming. So all of these, E, S, and G, we can actually think of using as return drivers exactly like value, quality, momentum, and the other broad and persistent drivers of returns called factors. And that was what really brought us some insight, is that done correctly, E, S, and G represent tremendous alpha opportunities. We do care about ESG in their own right, but I, as an investor, also care about ESG to reduce my risk and to improve my return. Ultimately, as investors, we do care about these other issues, but we have to focus on the importance of improving and generating returns for our clients. So let me talk about how we might incorporate ESG into our portfolios. And there are really three ways that we can do. The first, you might think of as divestments. We can remove companies to align with your values. The second is that we can go beyond looking at screens to seeking ESG outcomes in their own right. So we can improve ESG metrics of a portfolio, so we can uplift ESG scores. We might also target certain of the E, S, or G. Some of our recent work has created Paris-aligned portfolios. These Paris-aligned portfolios immediately cut carbon reductions by 50%, and they continue to cut carbon by 7% year on year to reach a net zero target by 2050. Net zero being the same amount of carbon in the atmosphere as between 1850 and 1900, before the Industrial Revolution. And finally, I think the most exciting of all of them is to use ESG data as alpha returns and incorporate them into how we think about reducing risk and incrementally improving our returns. I'll first note that if you are doing factors in your portfolio and they are pervasive, if you hold low volatility stocks, and if you hold or seek quality companies, you have significantly better ESG profiles than the average investor. Here are some correlations of ESG metrics with some factor scores. Momentum and value tend to have approximately the same ESG profiles as the market portfolio. Size is significantly negative. And I think that's mostly because of data biases. We still have a lot of companies that do not report ESG data, and they tend to be the smaller companies. Over time, as more and more companies will report ESG data, I think those biases will be removed. Most of the ESG score providers tend to disadvantage companies which do not provide that ESG information. So that correlation will improve gradually over time. If you are a factor investor in your portfolio already, holding a multi-factor combination of low volatility, quality, momentum, value, and even size, you are already an ESG investor. As I said, we can use these facts to our advantage and use ESG to create specific ESG outcomes. So we can use this to our advantage in reducing volatility and increasing ESG, or seeking high companies and also improving our ESG. Let me go to the final way that we can incorporate factors into portfolios, which I called insights, to enhance alpha by ESG insights. And that's a paper that came out in the Journal of Impact and ESG Investing. And after this, if you're interested in that paper, we can send a link to that research. Okay, let me go straight to the first example. And we're going to call this an example of intangible green value. Now, I have a patent for an invention in finance, but generally in our industry in finance, patents are not worth that much. But in other industries like technology and pharma, patents are very valuable. Patents do not usually appear on a balance sheet, and they're not separately accounted for in an earnings statement. But patents are a way that we have put in intellectual property, and they are valuable assets. They can be licensed, and patents can be bought and sold. If we look at this graph here, we show the relationship between the awarding of patents and research and development spending. Often, patents are the culmination of investments done in research and development. The investments in R&D actually increase before the patent is awarded. And that makes sense because we're actually putting in that research that is awarded a patent. But interestingly, that investment also increases after the patent is awarded. We need to commercialize that patent, and that patent has to be built into our business processes. So this is an example where we can see patents as another source of information, very valuable, and usually not one that appears on balance sheets or earnings statements. It's an alternative data set. So patents represent intangible capital. Now, there are different sorts of patents. There are green patents and brown patents and white patents. Green patents are patents that are filed under fields corresponding to UN Sustainable Development Goals, or SDGs. So these patents directly apply to one of the 17 UN SDGs. These green patents are an ESG form of data. By definition, they meet UN SDGs. But they are also valuable to generate alpha because they represent a form of fundamental value. We can treat it like we do other metrics for value. So it complements traditional financial measures of value. Now, because it's a value signal, it is correlated, but it is additive to traditional benchmark values, which tend to be formed only from balance sheet information. So this is one way that we can use ESG information to increase our returns. Let me close with another example, which is on corporate culture. And if our pandemic has taught us a few things, it's that the most successful companies have been able to generate business, conduct commerce, and continue sales, largely due to cohesive corporate culture, making us effective team players in a remote work environment. Corporate culture, however, is hard to directly measure. It tends to be a more qualitative characteristic as opposed to a more quantitative characteristic. What we do is we can measure corporate culture following some research by Guizzo, Sapienza, and Zingales. And this is the paper that we base our research on. They define 5 pillars of corporate culture. They're on the left-hand side of the slide: innovation, integrity, quality, respect, and teamwork. We apply machine learning techniques to estimate corporate culture. The actual technique that we use is based on some machine learning algorithms that are done in deep learning. And we can create from these 5 pillars a dictionary. The algorithm adds words that are associated with each of these core corporate culture values. Some examples are on the right-hand side. So integrity, for example, is associated through that machine learning with ethics and accountability. We apply this machine learning to text information. These informations are called corpuses. And one very valuable set of information is conference call transcripts. So from this, we can then take this learning and create a signal for corporate culture. And this is some of the performance. This is highly complementary and additive to traditional measures of quality, which rely on financial information. So ESG for us represents not only an important outcome as an ESG outcome in its own right, but we think the next frontier is using ESG to create returns. ESG done right represents alpha. Thank you very much.
네, 유익한 강연을 진행해 주신
Thank you very much, Managing Director Yong from BlackRock. Thank you. Now we'll have a panel discussion on the presentations that were given during this session. Professor Chung will chair the panel discussion today. And on the panel today are Mr. Yong from BlackRock and Mr. Jin-Soo Yoon from the Korea Corporate Governance Service and Mr. Sang-hee An from the Daeshin Economic Research Institute. Thank you.
네, 안녕하세요.
Yes, good morning. We'll begin our panel discussion.
Thank you.
Thank you. And your presentation is well received here in Korea, and very impressive presentation. I'll just ask you one question regarding the BlackRock and your ESG scoring and your methodology factor model, the value of ESG, what you just presented. Compared to traditional investment, alternative investment space, ESG application consideration scoring system is not progressed yet. And how do you think, how do you feel about that, the issue? What we need to do for the alternative investment space in order to proceed ESG up to the level of traditional investment system? What we don't have, what we already have.
I think alternatives for ESG, we should divide into two main groups. One is liquid alternatives, and the other one is illiquid private markets. For the first liquid alternatives, at BlackRock, we have a series of long-short liquid alternatives that apply ESG signals exactly like the presentation that I gave. And we think of ESG as an alpha source. So it's no different than, I think, most traditional liquid alternatives, except we're explicitly using ESG to create an ESG outcome and use it to generate alpha at the same time. The illiquid private market space is just beginning. We've actually applied big data and machine learning techniques to growth equity, and we have research in the pipeline to real estate, venture capital, and other types of private market securities too. It turns out that many of the alternative ESG data sets do have some information about private market companies, but it's not from the standard ESG score providers. And those data providers tend not to have any information on private markets at all. Rather, if we can scrape data from the web, if we can look at satellite imagery, if we can parse social media, if we can use some of the techniques like patents that I walked through, private companies are rewarded patents too. And if we look at some of the text information, if we look at news flow, we can apply the same deep learning machine language techniques that we have on public data as easily to private markets as well. So we're actually quite far along in applying ESG to private markets in the same way. We think of ESG as alpha.
Thank you. You just said private market, illiquid market versus liquid market for the alternative investments. And you said alternative data. Well, if we think about the not alternative data, traditional data, which can be applied to the can be used to the ESG scoring system, which is public data. The alpha created from public data versus the potential alpha created from alternative data, the synergy to creating alpha, we can believe in the alternative data side is bigger. Do you agree that? Then the synergy between between the traditional investment ESG based investment versus alternative investment, especially illiquid alternative investment, ESG investment, we can create more alpha in the later, the second alternative investment, illiquid alternative investment base area. How do you feel about that kind of theory?
I believe that the most promising sets of information to generate alpha in any market, be it liquid or illiquid, public or private, the most promising data sets are those that are not used by everyone. And the fewer people that use it, I think the more valuable that data source becomes. ESG is not widely used by many investors, even in public markets. There is still a long way to go, and even fewer people are using ESG data explicitly to create alpha signals. And that's, I think, true in all markets. And I think that's why ESG data, using ESG to explicitly enhance returns, is such an exciting frontier, and one where I think we will be using and exploring for decades to come. It will be a long journey for most investors to incorporate ESG as alpha return drivers. And that's why I think ESG data is so exciting and so valuable.
Thank you. Thank you. Now I can introduce our panels, the local panels. We have two panels here. 윤진수 기업 지배 구조.
First is Mr. Jin-soo Yoon, Head of Analysis Division at the Korea Corporate Governance Service. Another panelist is Mr. Sang-hee An, Head of Responsible Investment Center at the Daeshin Economic Research Institute. I would like to pose the same question to both of you. Either one of you can answer this question. Currently in Korea, ESG is having quite an impact in the market, and a lot of LPs, pension funds, and others are trying to give a mandate of ESG investment. And in the hope of doing that from the perspective of GPs, as a managers, ESG is now becoming a must, not an option or a choice. As such, some of the asset managers are trying to increase their expertise in ESG voluntarily by setting up a dedicated committee and so forth. But otherwise, on the other hand, other asset managers are being forced to do ESG investment, and they're just trying to follow others in the market. The two of you who are here as panelists, in terms of ESG scoring system and so forth, I believe that your responsibilities are related to that aspect of ESG scoring. So from your perspectives, from the perspectives of rating size, what would be the pros and cons of this ESG trend that's prevalent in the Korean market? Who would like to go first? Yes, Mr. Yoon, please. Good morning. My name is Jin-soo Yoon from the Corporate Governance Service. As was mentioned, policy financial institutions are taking a greater interest in ESG investment. The KDB recently has given out a mandate of ESG, and they have set up a monitoring system for monitoring the performance by their asset managers based on ESG factors. And at the same time, when evaluating PEFs, ESG improvement of their holdings will be reflected in the performance evaluation. I understand that was the study that was commissioned by another policy institution. It is definitely true that this could pose something of a burden on GPs. But of the domestic PEFs, ESG has been being prepared by most of them, and there are definitely some PEFs who are making solid preparations to incorporate ESG factors in their investment. That is my personal understanding. As such, in trying to increase the expertise on ESG on the part of asset managers, I believe that the pressures coming from the policy institutions that I just mentioned could become an opportunity for them. But when you think of PEFs and venture capitals, when it comes to evaluating their performance, we'll have to definitely set up some criteria and standards for performance evaluation. And of course, that needs a lot of discussion going forward. So from my perspective, I think it could be a bit of a challenge in trying to clearly define the monitoring standards. Thank you.
Thank you very much, Mr. An. Do you have anything more to add? So when it comes to alternative investing ESG, before we talk about KCGS and Sustain Invest, and among the three ESG institutional investors, unfortunately, the institution is not here, but there are many institutional investors that are focusing on ESG. There are also latecomers in the market for the ESG scoring. Many candidates there in the market, which are now trying to move into this rather new frontier. As we were listening to our first keynote presentation, well, actually, when I was delivering my presentation, I did some research, especially our three scoring companies in Korea and also other international scoring companies. What's the current status of development, and KCGS and Sustain Invest, especially focusing on KCGS, the evaluation methodologies, the number of companies to be evaluated, how frequent they are updating their information, how the outcomes of the evaluation have been reflected into the investment, what is the difference between high scores and the low scores. And we did the research together with the students from the graduate school, that the conclusion is that results are still quite lacking, still a long way to go. For example, compared to MSCI benchmark, but not only compared to MSCI, but other leading ESG scoring companies, their sheer volume of data and the method they use for data cleansing, data curation, and data use, and method of analysis and updating methods in many domains, that we still have a long way to go compared to the international players. And even the publicly disclosed information, there's really a lack of it. And I asked a question to Mr. Andrew, that we have the traditional data that is in the public side, and the qualitative data that has not been made public, and other type of data, we call it alternative data, that has not been made public. And many domestic scoring companies are not really making full use of that. That was the result that we got from the research work. So do you agree with my perspective, and what is driving this issue? Because this is a way to go forward. What do we need to do for improvement? What can we expect from the market in terms of assistance? What do we need to do to raise awareness? What about the academic circle? What about the government? What do these other stakeholders have to do to ensure development of the ESG scoring market? We talk about, for example, to make our infrastructure more robust. What do we need to do? I would like to ask Mr. An for his comments first. Hello, I am from Daejeon Economic Research Institute. I'm An Sang-hee. So let me give my answer to the question first. And I have some comments to make, especially in terms of the impression that I've gotten from this conference. In Korea, ESG scoring has been around for some time, but the history is quite short, relatively speaking. especially the public companies, their raw data that is used by the scoring companies or the information that has been disclosed, it's quite limited. We first need to promote public disclosure of the information to drive improvement and development in the market, whether it is their sustainability report or whether they're in the form of a website. There should be raw data coming from the raw data coming in relation to the ESG performance. And we also need to have institutional framework put in place. Especially, this effort has been around since last year. But among the three factors of ESG, a lot of work has been focused on governance. So we want more limelight to be given to E and S as well. And one of the hot topics in the market is that there are too many diverse scoring criteria, and they're not really easily accessible to companies. So the need for standardization of the scoring criteria, I think it's a double-edged sword in a way, because there's too much diversity in scoring criteria, then that would lead to the need for standardization. But if you just come up with a very standardized, uniform set of criteria, then that is not really going to be useful. Many domestic scoring companies, for example, are utilizing different criteria for evaluating companies' performance. ESG scoring is exactly the same because it reflects the guiding principles and philosophies of certain management companies. So we need to, of course, do some standardization in terms of the ESG criteria, but it should not be a uniform set of criteria. So we have to strike a good balance between standardization and uniformity. And may I also speak about the topic of the conference? Yes, please go ahead. Now that I'm taking part at the conference, I understand that this is a very huge wave that we see a move towards ESG investing in alternative investment as well. We have traditional asset investment, for example, real estate, PE, and there are other alternative forms of investment available out there. And I think the conference theme is now delving into the relations between the ESG principles and alternative investment. I want to first talk about the size of the Korean market when it comes to ESG investing. The Global Sustainability Alliance is saying the AUM for ESG is about $35.3 trillion AUM, which is about 15% growth from 2015. And out of that, it accounts for about 13% for alternative investment, which is a significant growth compared to previous years. Now, if you turn your eye to the domestic market, as the GAIC chairman rightly noted, out of the total AUM, alternative investment accounts for about 16%, and by 2021, they're going to increase the portion to 21% of the total investment. And for National Pension Service, at the end of last year, alternative investment accounted for about 99 trillion won. Compared to 2 years, that's an 80% growth. That's a significant growth in and of itself. But out of the total asset, if you look at the portion of alternative assets at the end of last year, it's about 10.8%. Compared to 2 years ago, it has actually come down compared to the previous level of 12%. If you look at the first half of this year, it's at 10.4% level. And from the point of NPS, out of the total alternative investment, out of the total investment was 9 trillion won. But the share of alternative investment will increase to 95 trillion won. And out of that, especially for the real estate, is 33 trillion won. That's about 35% of the alternative investment. So real estate still accounts for a lion's share of their alternative investment. So ESG scoring criteria for real estate, that's a very important issue to discuss. I know that there will be some comments made by Mr. Yoon. I think there is a need to do further research or follow up. In terms of the information disclosure, I just want to make one final comment. According to the REITs Association of the U.S., out of the 100 REITs in terms of market valuation, out of the 100 largest companies, about 98 of the rich companies are disclosing their performance in ESG, and about half of those companies are publishing their separate sustainability reports. For those rich companies under 5 trillion won in size, 97%, so that's 97 companies out of 100, are publishing sustainability reports. Of course, if you look at Korean companies, they're also moving towards publishing sustainability reports. But before getting the scoring, perhaps not at the global benchmark, but in terms of public information disclosure, I think there's a lot of work to be done so that we can really prop up strong growth in the domestic market. Thank you. Thank you.
Thank you, Mr. Yoon. Do you have anything to add related to the points that were just raised? I believe that the other panelist has sufficiently talked about the issue that we are talking about today. Regarding the disclosure requirement, I believe that the relevant ministries in Korea are struggling to come up with a solution. There was a recent policy announcement on this point, but I believe there is a little bit of confusion as we talk to businesses. The sustainability report that was talked about by the government is a broad framework of ESG, but when it comes to the perspectives of companies, they feel the cost burden of having to publish a thick book on sustainability that contains a ton of information. When it comes to the actual format of sustainability report, I believe that it will be up to the autonomy of each business for decision. What is most important is the ability of the report in providing relevant information regarding ESG factors. So I hope that the companies will not feel pressured or burdened by the title of the report that they need to publish. Recently, we deal with the issue of the sprouting of too many scoring systems in place in the market. As was mentioned by Mr. An, these scoring companies or the scoring agencies, of course, they have diverse and various sets of criteria. But what we need to make sure is that they include a diverse range of factors in coming up with the scores. And it is for this reason that some people are skeptical. ESG is a hot topic. It's a popular trend in the Korean market. And I know that a lot of people are rushing to develop and apply ESG scoring systems. But I wonder how much effort they have put into creating such scoring systems. The government has provided something like a guideline through the KGCS, and I believe that this will be a great point of reference for other institutions who are trying to develop their ESG scoring systems. But then again, I believe that there will be more thoughts that need to be put into the specifics and details. Thank you very much. What you just mentioned is very pertinent. The government has provided guidelines through KGCS. This can be a good guideline and a point of reference, and I agree on that view. ESG is a good topic. When I was making my presentation, I talked about sustainable investment and responsible investment. As we look ahead into the future, we need to definitely think about ethical issues, climate issues. So all of these topics are very relevant, and it's a proper direction that we need to adopt. into the future. But as was just mentioned by the panelists, right from the point when the government starts to provide a guideline and regulate something, then it could be a double-edged sword. The objectivity and fairness of the ESG scoring guidelines is something that the market is expecting from the government. So the guidelines, if provided by the government, should be definitely fair and objective. That will be my final comment during this session. I would like to thank the two panelists for joining us today. I understand that there is no question posed by online participants. So with this, let me conclude this session. Thank you very much, Professor Chung, as well as Mr. Yoon from the KGCS and Mr. An from the Daesin Economic Research Institute. This will conclude the panel discussion for session 1. And with this, we are at the end of the morning program today. The afternoon session will begin at 1. Please be on time at 1 p.m. Thank you.
뭐지? 여기에 뜬. 똑같이 뜨는 거. 내가 누르면 별로 없는데. 보시면 얘는 이제 안 켜지고 하여튼 둘 다 켜지잖아. 오버라이드가 이제 둘 다 켜져. 얘가 키면 얘가 꺼져야 되는 거고.
잠시 후 1시부터
Starting shortly from 1 o'clock, the afternoon program of GAIC 2021 will begin. We have English and Korean interpretation services available. If you have any comments or questions during the lectures, please be sure to leave them in the chatting room. Starting from 1 o'clock, the afternoon program of GAIC 2021 will begin. The conference offers interpretation services for both Korean and English. We have 2 separate channels available for the audience. If you have any questions or comments, please be sure to leave them in the chat room. Thank you, and we will see you soon. Welcome back to the afternoon program of the Global Alternative Investment Conference 2021. We have many experts who will be delivering insightful presentations in the afternoon as well, so your continued participation will be greatly appreciated. Let's now kick off the afternoon program, session 2 of GAIC. We are going to be looking at ESG applications in HF, PEF, PDF, PCF, real estate, and infra. We're going to have a presentation by Mr. Dick Blewett, a partner at Kennedy Lewis.
Hi, everybody. Hopefully I'm coming through okay. Good afternoon, and thanks for having me. And I'm very excited to be here. It appears that my Zoom is working correctly, so that's great. And great to meet you all and see you all virtually. My background is, I'm Dick Blewett, and my background is that of a partner at Tactical Opportunities and co-head of ESG for Kennedy Lewis Investment Management. I focus on private asset-based credit, which includes renewables, things like mortgage finance, aviation, consumer credit, amongst others. Prior to joining Kennedy Lewis a year and a half ago, I held senior positions in structured finance and credit products at both BlackRock and Blackstone, where I worked with a number of my current partners. I've got about 10 or 15 minutes here, I'm told, to give you some of my background and our firm and how we're approaching ESG, and that's very exciting for us. A minute or so on Kennedy Lewis, just to give you a sense of who we are and what we do. And at Kennedy Lewis, we focus on an all-weather, defensively oriented approach across a broad range of opportunities that are less correlated to the broader credit markets. Things like life sciences, power, TMT, home builder finance, aviation, amongst others. And in particular, we look to be a solution partner to companies and industries that are undergoing some type of disruption, things like regulatory or cyclical or secular. That's where we can extract some additional upside from the credit improvement of the underlying company, while at the same time ensuring we have ample downside protection through our collateral asset coverage of our loans. We're a little different from other private credit players in that our capital is intentionally very flexible, and we're able to take advantage of opportunities which don't really fall neatly into the investment parameters that limit some other managers who must stay in their respective lanes. I'd say that our main goal at Kennedy Lewis is to structure loans that set companies up to succeed. This not only includes traditional metrics of success, such as profits or market share and growth, but environmental, social, and governance issues. The latter, I think, as many people on this conference, on this call, and on this conference are familiar with, increasingly have high visibility with customers and other stakeholders, and they're really paying attention to how companies respond to these issues. Just quickly to set the table, it's not meant to be trite, but what is ESG? It's a widely used term to describe certain issues investors consider in the evaluation of corporate behavior. There's a lot of focus on material, non-financial considerations, and it's often used in the context of responsible investing. And it's motivated by an interest in corporate impact and sustainability and business ethics. The E or environmental, it considers a company's impact on the planet in both positive and negative ways. It's based on the desire to invest in companies that are actively good stewards for the environment. From a social perspective, it's people-related elements like company culture and issues that impact employees, customers, consumers, suppliers, and other stakeholders, both within the company and in greater society as a whole. And finally, governance. Obviously, self-stated how the business is run and whether the corporate incentives align with the business's success. It's a natural question to think about or ask, why would ESG be relevant or important to a company? And there's a whole host of issues. A few that pop to mind, and I view it, we view as pretty important, is that it includes access to capital, brand protection and corporate values, cost reductions, things like energy efficiency and insurance. It's incredibly important for employee recruitment and retention, which ultimately leads to fiduciary responsibility. It has to do with asset revenue growth and potentially gross margin protection. And at its core, in some cases, it could have to do a lot with regulatory positioning and legal liabilities, and ultimately a license to operate. At the end of the day, it's good corporate stewardship, to sum it up. And to that end, there was a recent McKinsey global survey a year or two ago. It showed that over 80% of C-suite leaders and investment professionals say they expect that ESG programs will contribute more shareholder value in 5 years than today. So clearly, people that matter are paying a lot of attention. For Kennedy Lewis, our approach, we've been asked to talk about how we approached ESG integration in our firm. And the first thing that we did a little over a year ago, we decided to become a signatory to the United Nations Principles for Responsible Investment, or PRI. As I think you know, this is a series of 6 investment principles that offer a menu of possible actions for incorporating ESG issues into investment practice. In air quotes, it's developed by investors for investors, with the aim of developing a more sustainable global financial system. Kennedy Lewis became a UN PRI signatory in July of last year, and we are on track to be submitting our first annual report later this year. So, and then the second thing that we did, big picture, in terms of ESG integration at the firm, was a policy development. So we developed and made publicly available an ESG policy that will apply to all of our investments as well as our own operations. Second, we have designated individuals responsible for overall ESG management, as well as incorporation of ESG considerations into our investment process. We have co-heads of ESG. There's me. And my partner, Mark Crawford, who is also a head of power as well as my co-head for ESG. And then finally, the firm has made a commitment to training the entire team. It's not just the senior folks or a couple of investment professionals. We feel it's really important for the whole infrastructure to have buy-in to the ESG approach. Further parts of our ESG integration had to do with some guiding principles around the E, the S, and the G. From an environmental perspective, we're looking to have all applicable laws and regulations complied with, and that includes environmental matters such as air quality, water and wastewater management, solid waste management. Looking to take advantage of opportunities to shift away from generation sources of power like coal and oil towards more cost competitive, low carbon footprint, natural gas fired capacity, and especially renewable resources. And then to endeavor to curb activities that may contribute to the climate change crisis, energy and material consumption, and waste generation. From a social perspective, social matters such as human rights, child labor, health and safety and forced labor. Look to establish a culture that has zero tolerance toward any perceived or actual form of discrimination. From a recruiting and managing professional standpoint, that would include good working conditions, things like health and safety of all employees, competitive pay, and a combination of supplemental benefits that aims to attract and retain diverse and high-achieving professionals. And at the end of the day, prioritize the welfare of customers and other stakeholders. And then finally, from a governance perspective, again, looking to comply with all applicable laws and regulations, including those around things like business conduct such as bribery, anti-money laundering, and corruption. You need to establish a clear corporate governance structure and process, and also to work to ensure that all employees and partners operate with professional integrity. The kind of most important part, I would say, is that integrating ESG throughout an investment life cycle is really important, because we think, and I think a lot of people agree with us, I hope they do anyway, is that maximum value creation from ESG results from incorporating it at all stages of the investment life cycle. So at the front end of sourcing, through due diligence and deal structuring, asset management, and ultimately an exit or sale or maturity of the position. Some examples from each one of those, for example, in sourcing, We use a negative screen for certain industries. Those include things like alcohol, coal, illicit drug production, things like payday lenders and debt trap type products, pornography, prisons, tobacco, weapons. Yeah, I don't think those are surprises for a lot of people, but it's an important initial and relatively base level negative screen for certain industries. From a due diligence perspective, we'll, one, try and identify material ESG considerations that may arise. Two, understand the relevant downside risks associated with those ESG considerations. And three, evaluate whether we think such risks can be mitigated. For example, based on whether the target company is going to be able to or willing to implement measures to mitigate that risk, and our ability or our relative ability to enact desired change. And sometimes that comes with being a significant debt investors, and sometimes it comes with having more of an equity stake. And those two things aren't always the same. Our team selects ESG topics for evaluation based on the industry sector or the vertical in which that company operates that ties into our team verticals and industry sector dispersion. And we use our own internal guidelines for evaluating the E, the S, the G factors. And if necessary, we have no issues with bringing on a third-party consultant for additional support beyond our own internally developed guidelines. In order to focus on material ESG issues, as I mentioned, we use our own experience, but we also lever off of guidance developed by the Sustainability and Accounting Standards Board, or SASB, and not to be confused with SASB in commercial real estate, but the Sustainability Accounting Standards Board. And that's, I think, as many of you know, but just for those of you that might not, it's an independent nonprofit organization that provides sustainability accounting standards for use by public companies. And they've identified material ESG topics for over 77 industries in 11 different sectors. So from our perspective, we're always trying to evaluate a target's management of the key topics, and the risks that we identify effectively equal potential liabilities, and the gaps equal potential opportunities. From a deal structuring perspective, just kind of moving through the life cycle, as I alluded to earlier, of how we're trying to integrate here, if our team concludes that there's a material ESG consideration relating to an investment, we're going to consider structuring indentures or covenants for downside protection and to ensure that the company devotes the necessary resources and attention to carefully manage that ESG consideration. Each investment we structure so that Kennedy Lewis has oversight to ensure that compliance with the investment covenants. Other ways that we sometimes try and kind of influence an outcome or be sure that we at least our voice is heard. We may also seek board representation or at the very least board observer rights in certain situations. Which brings us to asset management and exit. And this is almost regardless of our position within a capital structure. We're going to be actively involved with each portfolio company from the onset. Each investment is assigned a senior investment professional who's responsible for day-to-day management and monitoring of the investment. And this professional conducts regular calls with the portfolio company management during both the monitoring and asset management period. Our investment professionals are consulted by the company's management team on material issues. And that, of course, would include ESG-related considerations. And that may affect the viability of an investment. It could affect the reputation of Kennedy Lewis, or it could affect relationships with portfolio companies or co-investors. When we exit an investment, we ourselves, along with management, we may decide, and we'd like to do this if it's feasible, to conduct a review of how the company's ESG profile and related considerations improved or evolved during our hold period. Basically, a review of what went wrong and what went right. I'm getting kind of virtually kicked under the table because I want to go on for as long as someone would be willing to let me have the mic. So I apologize in advance, but But just a couple things to keep in mind as we drive forward here. Integrating ESG in private credit and debt investing is key. Many investors are beginning to evaluate ESG value creation opportunities during that due diligence and post-close period, in addition to managing ongoing ESG risks. And aligning that ESG policy with business strategy is really important. You're kind of moving on the continuum from what should I be worrying about to what should I be thinking about to what should I be doing. And that continuum of ESG integration to impact investing is moving from being mindful and cautious to intentional and opportunistic. And ultimately, from our perspective, it just makes sense. As I mentioned previously, access to capital is going to be increasingly driven by LPs requesting more information about GPs' responsible investment practices. Period. Full stop. There's not going to be less. There's going to be more. And so, to us, that's a very basic view of the world that the business case for ESG integration feels quite strong. As I said, I'll stop there, and I appreciate you giving me the time here to kick this off, and I look forward to the rest of our panel discussion.
Thank you very much. That was Mr. Dick Blewett, a partner at Kennedy Lewis Investment Management. Thank you for the presentation. Now we will have the second presentation, which will be delivered by our morning keynote speaker, who is the senior lecturer at Harvard Business School, Dr. Randolph Cohen.
I think you might be on mute.
Sorry about that. Okay. Hopefully you can hear me now. So it's great to be back. I had the opportunity in this morning session to talk about ESG, and so I'm going to keep my promise from this morning to talk a little about liquid private equity now, which, as I mentioned earlier, I think has interesting connections to ESG. So the idea behind liquid private equity is really exciting because, look, private equity is super attractive because of its performance, right? Average returns are higher than the stock market. There's downside protection in that when the market crashes, private equity doesn't go down nearly as much. And there's a low enough correlation with stocks and bonds that if you add private equity to a stock bond portfolio, you significantly improve expected return, maybe by a couple hundred basis points a year, while keeping volatility fixed or even reducing it. And so that's why the short history of institutional investing over the last 30 years is they went from 60-40 to 50-30-20 with 20% in private equity. Obviously, that's a very oversimplified history, but just it gives you a sense, and it's been very, very effective and very powerful. So that's great, but private equity has two challenges associated with it. The first is a lack of liquidity, of course, and the second is challenges with regard to access. Now, the people at this conference don't have any access problem. That's more an issue for retail investors and certain, smaller institutions and others with various kinds of restrictions that keep them investing in from investing in private equity. Although insurance companies are one group that struggles to access private equity, and there may be some insurance firms here at the conference. So access can be an important limiting factor in people's abilities to invest in PE. But even people who are big private equity investors deal with liquidity problems associated with private equity. And what's beautiful about liquid private equity is it doesn't need to replace a single dollar of private equity in your portfolio. Where it's super helpful is to be a tool in the asset management toolbox for private equity managers. And the way I like to think about this is the simplest use case is, well, suppose you have a bunch of capital and you're ready to allocate to private equity. So you could imagine, for example, an individual who sold their business at age 65, and now they have a pile of money that they want to invest, and they want to invest some in private equity. Or think of an institutional investor where the board just voted to go from 15% private equity to 20% private equity. So now you have an extra 5%. Let's say it's a $10 billion pool, and they voted to go from 15% PE to 20%. So now they're going to take $500 million and they're going to identify a group of great private equity funds. They're going to allocate to those funds $500 million, and that's terrific. We think, even as supporters of liquid private equity, we think that's a really smart thing to do. But then here's the problem. It's going to take 5 to 7 years before those private equity firms draw down that $500 million of capital. And so during that time, you're not at 20% private equity, you're at 15, slowly creeping your way up to 20. And our feeling is there's a simple solution to this, and that's to invest, to do all the allocations that one would normally do. Absolutely invest in all those great private equity funds, but then also take $500 million and place it in liquid private equity. And then every time you get a capital call from one of those $500 million worth of PE firms, then simply take the money out of liquid private equity and into traditional private equity. So in other words, you immediately go to 20% PE, 15% traditional, 5% liquid. And then over time, you go from 15 and 5, 16 and 4, 17 and 3, et cetera. Now, here's what's interesting. It typically will never get all the way to the full 20% because private equity investors have a huge problem with what people sometimes refer to as the funding asset for their private equity. One simple way to think of it is this. Suppose that you make an investment with a great private equity firm, you give Blackstone a bunch of money. Blackstone invests it incredibly successfully, and they send you back $300 million. Wonderful. You have $300 million. Now, you know that that money is going to be called on capital calls from other private equity firms or from the Blackstone fund over the course of time. But you don't know if those capital calls are coming tomorrow or in a month or in 5 months or in 12 months. So what do you do with the $300 million? Well, it needs to be in something liquid. If it's not liquid, it's not accessible for capital calls. But the problem is that liquid assets don't perform as well as private equity traditionally. If you put money in cash, you get basically zero return. If you put money in an index fund, you get a market return, which is well below private equity returns. And you have the additional disadvantage that if the market crashes, you'll take a huge loss and have trouble making capital calls. So there's not a great funding asset solution out there, but liquid private equity is the solution. And it's so powerful because what it does is it not only gives you a place to put cash to keep it liquid while you're waiting for it to be drawn down into private equity funds, but a place that delivers private equity returns, private equity downside protection, and private equity lack of correlation, all those great features of private equity. So, but because it does all that, it solves another major problem of private equity allocators. We've talked to over 150 institutional investors about this product, and what we have consistently heard is that they feel the need to say yes to private equity funds that are not great. In other words, they invest in great funds, and they'd like to invest only in great funds, but in reality, what they find is that if they have the opportunity to re-up into a fund that they have invested in historically that they thought was great 5 years ago on Fund 3, but now is on Fund 6 and they think they're just okay. The fund has gotten much larger in size and can't do the kind of small, juicy deals they used to. Key members of the team have left and in fact have joined competitors or created competitors so that the space is much more competitive for deals. Suddenly that fund doesn't look that great anymore, but there's a tendency to say yes just to keep the money working. And so what we say is with liquid private equity, what a giant pension fund manager said to us, with liquid private equity, I can say no to everybody who isn't terrific. And then when I find great private equity funds, I can invest huge because I've kept my money liquid and I've kept my dry powder for those circumstances. So we think liquid private equity is super powerful. And at PEO Partners, we have created vehicles to do liquid private equity. How do we do it? Well, as I mentioned earlier, with liquid private equity, the first step is to find out what private equity owns. Now, there are two things that if you don't do them, you can't call yourself liquid private equity with a straight face. The first is that you have to allocate to the same industries that private equity does, because private equity makes huge industry bets and they are fantastically good at it. Okay, and that is very well documented in terrific academic papers by my MIT colleague, Mark Kritzman, by my potential co-author, Oleg Gretel of Tulane, and in our own internal research. It is very clear it is very clear that these folks do a great job picking industries, and they make huge industry bets. Just to give you an idea how big the bets they make are, in the public markets, healthcare and banking are similar size industries. Healthcare is just a little bit bigger, but in private equity portfolios, there's 14 times more money in healthcare than there is in banking. So big bets made by private equity, and they change those bets all the time. If you look, you'll see that historically, private equity had very low allocation to software historically. It was viewed as this sort of high-tech thing that wasn't a fit. Private equity was more about manufacturing. Now, software is the biggest overweight in private equity portfolios, and healthcare is the second biggest. So they make big bets, they change them over the time, and they're great at it. So that's one thing you have to do if you're going to be doing liquid private equity. And because we have the data on what industries private equity is allocated to, we can perfectly match their biggest source of alpha, which is getting those industries right. We can also match private equity's second biggest source of alpha, and that is that they're in the right kinds of companies within each industry. What are those companies? They're what we call LBO-able companies, leverage buyout available companies. Those LBO-able companies combine high profitability with low multiple. Why high profitability? Because if you don't make a lot of profit, remember what an LBO is. You're going to borrow 3/4 of the money, and you're going to pay 8% interest because the borrowing costs on a blended basis are 8% for PE. So 3/4 of 8% is 6%. That means in order to do an LBO, a company has to have enough cash flow to pay out 6% of enterprise value every single year, right? That is an enormous amount of cash flow. So companies that can do that have to have very high profit, they have to have very high payout ratios, and they have to have low multiples, because if you pay 40 times earnings for a company, you simply cannot make those interest payments. So that's what we call an LBO-able company. Now, the beautiful thing is the LBO-able companies are the highest performing companies in the market. In fact, if you think about what an LBO is, you realize you have to have 5 things to be a typical LBO portfolio. You need to have that high profitability. You need to have a high payout ratio, because if you plow all those cash flows back into growth, you can't make your interest payments. Low multiple, as we mentioned. You're going to have small size companies relative to the S&P 500, because most of these are private companies that aren't nearly as big as the mega cap companies that dominate the global markets and the US markets, like Amazon and Apple. And finally, because you're levered, the L in LBO stands for leveraged. By being levered, you're going to have a high beta in the portfolio. Now, I studied for my PhD with I studied for my PhD with the great Eugene Fama at University of Chicago, and Gene won the Nobel Prize for a number of things, including his 5-factor model that lays out what kinds of companies perform the best. And there are 5 factors in that model, and 3 of them are things that have to be high, and those are the payout ratio, the profitability, and the beta, and 2 things have to be low, the multiple and the size. In other words, the exact 5 things that predict the performance of stocks in the Fama-French 5-factor model, which are the exact 5 things we do in our liquid private equity, are the exact 5 things that LBO firms do. So that's the second biggest source of alpha. You're in the right industries, which is the biggest source, and you're in the right kinds of companies within each industry, and that's the second biggest source of alpha. Okay, so now you're getting the right companies. You have to lever them the way that LBO levers. Now, LBO doesn't lever as much as people think, right? It's true that the typical deal is almost 3/4 debt. However, a typical public company has 30% debt. And the typical LBO-able public company, these high cash flow companies that we're talking about, has about 50% debt. So when you go from 50% debt for a typical LBO-able public company to 70% debt in the leveraged buyout market, you're only going up by about 1.3 to 1.5x. And so when we design products, that's the kind of leverage we use. We're only borrowing about 30 cents on the dollar, so very modest leverage, but enough to significantly enhance performance. Finally, in order to do liquid private equity right, you have to protect the downside. If you aren't finding a way to stop major losses when the markets crash, you're not doing true liquid private equity. So we use a sophisticated put spread strategy, a sophisticated derivative strategy to make sure that when markets crash, our performance is either not down at all or is only down modestly. So for example, in the first quarter of 2020, the stock market was down 20%. The LBOable companies were actually down a little more than the market because, of course, the low interest rate changes helped the companies with faraway cash flows more than the LBOable companies. So they were down more than the market. Private equity was only down 10%. Our model portfolio was down 8%. And in fact, one of our partner firms was live trading a version of our strategy, and they were only down 7%. So we delivered the very modest downside, the powerful protection that private equity delivers. Now, the private equity, of course, does not use derivatives. They don't hedge. The way private equity protects the downside is with mark-to-model accounting. That is to say, private equity can look at a situation in which stocks are way down, such as under COVID, and say, we think the market is overreacting. As bad as this situation is, we don't think that the market should be down as much as it is. And so we're only taking a modest markdown on our positions. They're able to do that because their companies are private and illiquid, and so no one can really say exactly what they're worth. But we have liquid public companies in our portfolio, and so we will have to mark our companies down the amount the market drops. However, we can then protect the downside with derivatives, and that's something that we can show over a 20-year history of this. I've been pitching this idea to the world for over 20 years now, and consistently, this approach to liquid private equity has been super effective at protecting the downside while delivering average performance that is well ahead of the stock market and indeed is ahead of private equity on average. So there's a lot more to say about liquid private equity, and I'd love to chat with any of you about it. But I think I should pass on to the next speaker for now, and then I'll rejoin for the panel discussion.
네, 랜돌프 코엔 하버드대 비즈니스 스쿨 교수.
Thank you very much. That was Mr. Randolph Cohen from HBS. Thank you very much for the presentation. The third presentation will be delivered by Mr. Harold Wolkett, who is the former head of ESG from Neta6 Investment Managers.
Well, thank you. I think that's the first time in my life I've been introduced in Korean, and thanks for having me. I'm joining you from Amsterdam, where, as you can see behind me, it seems like the city is just waking up, but very glad to be with you. I, until recently, was the head of ESG at Neta6 Investment Managers. I'm currently involved in a number of consulting projects regarding ESG, and I've been asked to speak today about ESG and alternatives. I'm just gonna share my screen here. I have one slide for you that I'd like to discuss. So it's also building on the previous speakers here, especially what Dick said about ESG. I think it's a very interesting time for ESG investing because, as Dick said, there's really sort of increased interest and activity in the investment market on ESG, and there's a broad range of tools that are being deployed, but also there's a broad range of objectives or considerations underlying ESG activities. And so that's what I would like to talk about here. What I'm showing is what I call the ESG matrix, and that tries to make sense of the different objectives that investors can have in fact, seeking out ESG investing, and then also the different tools that they have at their disposal. And so I think the reason I say it's an interesting time for ESG investing is that ESG has been around, I would say, about 15 to 20 years. If you take the launch of the Principles for Responsible Investment, or PRI, about 15 years ago as kind of like the starting point. And there's been a lot of academic research on ESG, and also obviously we have a lot of experience now as practitioners in deploying these instruments and kind of figuring out which of these tools are in fact effective. And so that is the point of this matrix, is to kind of show high level that it matters which objectives you have in mind in seeking out ESG tools, because not all of the tools are in fact effective for every particular objective. And so I'll go through this briefly, and it's good to keep in mind that even though this is based on sort of academic research and data and also real life experience, obviously this is an incredibly high level summary of what is a very sort of extensive and broad field. And so if there's any interest in looking into this further, obviously there's a lot of underlying research that I can point to if you're interested. Anyway, so on the left side of the matrix, what you will see is the different objectives that that investors can have, in my view. So it's one of three things, starting with values alignment, where often investors are drawn to ESG because it's kind of out of a sense of ethics or need to be seen as virtuous. And that often drives a lot of the initial ESG investment activity. But perhaps more important now are the other two considerations. So the second one is impact, or having some sort of influence on the world in a positive way. So they could either be influencing company behavior, or it could be contributing to solving real world problems like climate change, for example, or poverty or education. So just generally defined or summarized as impact. And then the third objective could be financial. So that's really related to business value, financial value, or financial risk. And so, as you can imagine, these three objectives are in fact quite different. And I always advise investors to be clear on what their objectives are. And often it's obviously a combination of these things, but in selecting their ESG tools to really kind of identify what are we trying to achieve. Because as you can see on the right side of the matrix, the different tools have different types of sort of different degrees of efficacy. Effectively, if you look at exclusions, for example, seems to work pretty well in terms of values alignment. The idea is, for example, you don't want to invest in tobacco out of sort of ethical considerations. It's very easy to divest from tobacco, and then that sort of checks that box, so to speak. But there isn't actually much, if any, evidence that exclusionary approaches also have real-world impact or are considered to be a good risk management tool. On the other hand, looking at active ownership, for example, as you can see, there's a check in every row for active ownership, and there's actually a lot of research on active ownership and the role that it can play in influencing company behavior and also having real world impact in being an effective risk management tool. And also, if done well, it's something that can contribute to financial performance. So I think, again, this is a very high level summary of something that is now coming out of the academic research, but also kind of taking practitioners' views from years of deploying these kinds of strategies. And I think, taken together, this kind of shows that I'm going to stop my share now so you can see me. So I think this shows that we're kind of at an inflection point. And as some of you may have seen, there's a lot of discussion in the market right now. There have been some academics and practitioners who've come out and criticized quite a lot of what is done now under the header of ESG and impact. So there's very lively debate. I think between the two sides, if you can call it sort of two sides in this debate. One saying ESG is really a useful tool that helps for all of these objectives. On the other hand, people saying you have to be a little bit more specific. We have to look at the research. We have to focus our efforts on the tools and activities that really work. And then obviously that assumes that you define what it is that you're setting out to do or that you hope to achieve. And so maybe just summarizing here, I think the bottom line for investors is that ESG is obviously it's an attractive area. There's a lot to be gained from it. It can be the combination of values alignment. It can help get better financial performance. It can allow you to have an impact on the world, but you really have to do your homework and think about exactly what you're trying to achieve. Also, depends what kind of investor you are. Obviously, what you're investing in, that also defines the possibilities that you have, for example, having a real world impact, which is generally much easier to do through private investments, infrastructure, for example, private equity is a good example, as compared to listed equity, for example. So again, be clear on your objectives, identify what it is that you're trying to do, and then that should drive really the makeup of your suite of ESG activities. And I think if the entire market is going to start doing that, I think over the next couple of years, we'll see ESG becoming sort of a much more effective discipline in contributing to solving some of the world's problems, and also obviously in contributing to effective risk management and financial performance. So I'll stop there, and I think we'll have some opportunity to discuss further on the panel discussion afterwards.
네, 헤럴드 월킷 전 나티시스 ESG 글로벌 부문 대표.
Thank you very much. That was Mr. Harold Wilkin, who was the former head of ESG and Natixis. Now we're going to have a discussion session on the presentations that were delivered. We're going to be inviting Professor Randolph Cohen from HBS and Mr. Harold Wilkin, who is the former head of ESG and Natixis, and Mr. Dick Blewett, partner at Kennedy Lewis. They will join the panelists, Mr. Kim Dong-hwan, CEO of Hana Ventures, and Seoungho Lee, professor at Hanyang University, and Lutchi, partner at Jecha Lee. The session will be moderated by Sehun Kim, Winston Kim, PCC Global Vice President. Thank you very much, especially our three presenters. I am Sehun Kim, Winston Kim, working at PCC Global. Now, we have Mr. Dong-hwan Kim joining us from Hana Ventures. Hello. So recently, I had a private meeting with Mr. Kim, and you made a very insightful comment that when it comes to ESG investing, especially with large companies like SK Group, and ESG investing is becoming a hot topic for many large companies in Korea. And you said in that private conversation, SK and other 10 largest companies in Korea, they have an enormous amount of capital to be put into for the fund management. And they could become companies like SoftBank, as they become one in the past. And in terms of the support and assistance given to ESG from the government, and I believe that venture capitals are very much sensitive to what the government is doing, and especially in the post-pandemic era. Are there any successful cases of investment in ESG? What is your outlook for the industry overall going forward? So thank you. That was a very broad question. So I will try to put my thoughts together as follows. SK and many large companies in Korea, as well as financial groups, are very much focused on ESG management and ESG investment. They're very interested in that. They're also executing their policies in that regards. As you may be very well aware, non-environment friendly businesses are being scaled down, and environment-friendly businesses and future-oriented businesses are being scaled up. And relatively speaking, I think that Korean companies are some of the front runners in the market. And when it comes to venture capital investment as well, we see similar trends. Not to really speak about any success cases, but venture capitals are making a lot of investments in ICT and healthcare industries. In terms of the tech businesses, they're mostly environment friendly. Because of the new technologies in the market, you can reduce the use of resources and also save energy. And for biohealthcare industry, this is good for the aging of society and helping the poor countries improve their medical healthcare welfare. So not to speak of a specific society, I think a lot of companies are moving towards that goal. And also the last letter of ESG, which is governance. We see there is a lot of improvement being made. A lot of media have talked about the problems that are brought about by large companies, especially top-tier companies. They're showing improvements in corporate governance and also rising startups, especially with the young managers in place compared to their previous generations. I'm not sure whether I could put it this way. I think they're becoming more open-minded, especially trying to listen to the voice of their employees as well as shareholders. Venture capitals and PE investors usually are taking part in the board as outside directors. And on the board, they become involved in the process of decision-making and express their views and perspectives. So it gives fresh perspectives to the existing board, especially as they work as outside directors and work towards improving corporate governance structure. I will end with that. Thank you very much.
Due to time constraints, I, of course, would love to hear you again sometime in this session. But now, let me invite Mr. Jae Lee from Key. Yes, good afternoon. I am saying hello from Shanghai, China. I understand that you are one of the first Koreans who got to work at Alibaba. And I understand that you have also served as the managing director at an investment firm in China. So you are one of the few Korean experts in the Chinese financial investment market. My understanding is that you also specialize in the consumables and so forth. Can you please touch upon the Chinese policy on the investment market, especially with a focus on ESG, and what are the responses on the part of the Chinese investors regarding ESG? Thank you very much. Let me talk about the ESG policy direction of the Chinese government. But before I do so, I think it's critical for me to touch upon the overall general policy direction of the Chinese government. The Chinese government is placing a focus on ESG investment as well. Recently, according to the announcements by the Chinese Communist Party, and if you look at the 14th Five-Year Economic Development Plan, you can sort of get signals as to the direction of the financial industry development going forward. And the Chinese government has made it clear of the sectors that they had in mind in future investment. I believe that there can be four keywords that we need to take note of. First is sustainable development. For the sake of sustainable development, for China to be able to join the ranks of advanced countries, they need to promote the development of technology sectors. So that is the first keyword. The second keyword is also very critical. This is co-prosperity. And this has to do with the social reform. This is a keyword that is greatly emphasized by the Xi Jinping government. As a matter of fact, In the past, their ultimate goal was to promote efficiency, but now they are shifting their focus to promoting the rule of law so that they can enjoy equal prosperity and wealth across all people of China. Top 1% of the Chinese people have the majority of the wealth in the nation, which is creating a lot of gaps in society. And the Chinese government is trying to address this issue. About 6 platform companies have made a contribution of about 30 trillion won to this cause. The third keyword is the national security, and the fourth keyword is carbon neutrality. The Chinese government is paying a lot of attention to promoting eco-friendliness. And if you look at the eco-friendly sectors and the renewable energy sectors that are being promoted by the Chinese government, maybe they have a direct bearing on the ESG investment. Before they announced this 5-year plan, in July, the political bureau of the Chinese government has also made some announcements regarding carbon neutrality, electric vehicles, and another sector as the 3 main industries that they want to focus on going forward. As accordingly, the various funds and investment firms of China will have to incorporate such policy direction on the part of the Chinese government in the future.
Thank you very much, Mr. Lee. As a China expert, you've shared with us your insightful ideas. I have another question to you, Mr. Lee. We had a phone call 3 days ago, and you said that the pushing group chairman has a lot of interest in implementing ESG policies. Not only the chairman of the pushing group, but also the mainstream investors in China and the top management teams are taking note of ESG investing. Those investment authorities in China, what do they think about ESG investing? To put it shortly, China, among the listed companies, is not mandating them to come up with the sustainability report. They're encouraging firms to publish sustainability reports. Only the listed firms are now taking a proactive approach towards ESG management. But if you look at the Shenzhen Stock Exchange, among the listed firms, the disclosure rate of the ESG reports is about 25%. As I was working at a Busan company before, I was there until August this year. At the company, if you look at the top floor of the head office, there's a reception room for visitors. In that space, there is a company overview section, which now talks about ESG policies, which did not exist before. So there's a lot of focus on ESG policy and use as a promotional tool for visitors. And also when they do earnings report, they also talk about ESG performance. And on top of that, ESG implementation is especially being discussed in the real estate development, finance, and insurance industries. What that means is that Hong Kong, Shanghai Stock Exchange, the fund is very much being sought for. And in the real estate market, in September 2020, 2020 Real Estate ESG Report Research Forum was held to focus on environment in terms of energy savings and urban development and industrialization. Also waste management. These different topics are being discussed at the forum. Thank you.
감사합니다.
Thank you very much for your response. Due to COVID-19, we were unable to invite you here in Seoul. Next, let me invite Professor Seoungho Lee from Hanyang University. Professor Lee has served as the CEO of one of the financial firms in Korea. So let me pose this question to you, Mr. Lee. From your perspective as a professor, how do you make of the policies of the Korean government in the financial market space? And at the same time, I understand that you have received some ESG training yourself. So can you please share that with us? And I understand that you're an expert in the global market as well. And now that we have panelists who are joining us from abroad, let me pose these questions to you before I hear from them. Yes, good afternoon. My name is Seoungho Lee. As a matter of fact, I prepared some questions myself to pose to two speakers who are joining us from abroad. But before I pose those questions, let me address those questions first. Prior to ESG, SRI was the keyword, was the catchphrase. But we're expanding this concept to cover ESG. Why? Because, as was mentioned by Professor Milton Friedman, the purpose or the goal of a company is to maximize profit to increase shareholder value. And its goal stops there. But in the case of ESG, we're emphasizing the sustainability of doing that activity. In the case of the Korean government, of course, the Korean economy has grown substantially. But if you're going to focus on sustaining such growth, then it is critical to make sure that investment is made in a way that incorporates ESG factors so that we can continue to generate sustainable profits for future generations of Korea. And I believe that is the main reason that we are focusing on ESG investment these days. One more factor to consider is as follows. When you make ESG investment, there are asset managers and there are people who give their money. Those are LPs. And up until now, LPs did not have a lot of demands or requirements. It was up to the discretion of the GPs in terms of managing those assets under their management. For instance, there were blind funds, and they're still with us today. But now it's a different story. The LPs are making greater voices, and they are demanding that their money be put into companies that are not engaged in activities that would harm us as humanity. As these investors are gaining greater voice and making their opinions heard, I believe that there is a greater call for ESG investments. These people are called the stakeholders, the customers, investors, and consumers. And up until now, shareholders had their voices heard, but now we're hearing louder voices from these stakeholders consisting of consumers, investors, and customers, and so forth. And that is why the government is also placing a focus on promoting ESG investment. Korean companies also do a lot of business outside the Korean market, and that is one more factor that's contributing to ESG investment on the part of Korean companies.
So from Long Island, we have Mr. Dick Blewett connecting to this conference. And I will just make my comments in English.
Are you there, Dick, from Long Island?
I am. I'm actually in New York City right now. So
okay, New York City right now. Yeah. So thank you so much for being part of this great show. It was very impressive last night when we talked about the ESG issues. You actually mentioned that a lot of regulator bodies in the U.S., including SEC and DOL, EPA, these government bodies are very into ESG policies. At the same time, I read recent articles of Clorox. Clorox is one of the largest U.S. retail companies, and they want to reduce plastic wrapping materials to recycling materials of 50% right now. And then until 2025, it's going to be 100%. And so we talked about yesterday. So what are the sentiments between the U.S. government bodies, at the same time these corporates or GPs when it comes to ESG policy and their reaction? Can you tell us a little bit more about your experience? And then
Yeah, absolutely. And thank you for that question. I would say that the current regulatory environment is almost more than it had been under the Trump organization. So President Biden and his administration, not that ESG wasn't a focus prior to that, but it's even more so now. So I think the large corporates that are faced with even if they don't agree necessarily that what they're being asked to do from an environmental perspective, which I think a lot of your question had to do with it, they have no choice, right? So they're going to have to find ways to distribute their products via vessels and containers that use fewer plastics, that will minimize environmental liabilities, that will then ultimately reduce the regulatory burden or litigation or very simply reputational risk. As I think many of us have seen, reputational risk can be huge, and you can wipe out decades of positivity. It seems in some cases these days almost overnight. So you combine that with hopefully lower operating costs or increased profitability through energy and other efficiencies, that makes logical financial sense. You alluded to Clorox. I don't want to either hold them up to be the best or jump on them for being a little bit behind, but it makes financial sense to do the right thing from an environmental perspective for them. And even if they don't want to, I don't think they have a choice. And to your point, LPs are going to be pressuring GPs, as I mentioned earlier in my opening remarks, to be investing with companies that behave in that fashion. So capital is going to become scarce if they don't kind of get on this train.
Okay, yeah, that's a perfect answer here. They appreciate it. I have one more question here. So, how is your Kennedy Lewis investment policy? Actually, earlier this year, what happened was very interesting. MPS, one of the largest funds in the world, they made an investment into UK fund, so that the UK fund can make an investment in the timber company, which was, I think, the $150 million, right? So when it comes to your situation, your organization, how would you see this? How can you pitch your investment policies, when it comes to this sort of things happening in the world right now?
I just want to be sure that I understand your question.
Well, I mean, like I said, the MPS, the National Pension Service, invested $150 million to UK fund, and that UK fund invested a timber company, right? So very recently. So as a GP professional, how would you see this? Do you have any internal sort of investment policies on an ESG at the moment right now? Maybe if you have some target company to invest right now in the future industries, if you could showcase what some of your experience and your current situation of the company, be appreciated.
Yeah, I think there might be two parts to that. What are things, how do we think about ESG and how do we, integrate it in our due diligence, perhaps? And I spent a little bit of time on that, and that degree of due diligence that we undertake regarding ESG issues and opportunity sets around different corporates is going to vary on the characteristics of a relevant company. Location, industry, size, the amount of information available about a particular company, and where our contemplated position might be within the capital structure. It is sometimes an unfortunate fact of life that a PE company can own a company and force change. Sometimes as a debt investor, especially if you're more senior in the capital stack, you can withhold your investment. You cannot make an investment grade or high yield investment in a company, but you don't often get to dictate terms the way an equity investor would. We try and structure our deals where we think we have ESG considerations, where we'll either have board oversight or board member where our voice will be heard. And if I understood it correctly, the second part of your question had to do with, what are the types of things that we're looking at now in terms of opportunity set, and that runs the gamut, and that runs the gamut from consumer finance companies with thoughtful ways in which they go about non-predatory consumer lending. We look at another company that we're looking at is medical equipment supplies, where the manufacturing is conducted in the US with suppliers primarily in Asia. Some water utilities and services and engineering and construction firms, water treatment plants are places where we've been spending different time. And again, that lines up with our major verticals, things like life sciences, power, technology, media and telecom, and kind of my world, which is more tactical opportunities, which covers more asset-based opportunities across different underlying asset classes. I'm not sure if I answered your question, but I tried. Yeah, it was very clear then, very, very broad and, detail-oriented. Appreciate it, Dick. Now I'm going to ask a question to, I'm going to ask a favor to Dr. Lee from Hanyang University. I think Dr. Lee probably has some questions on, ESG policies and things going on in the world. Maybe to Dr. Cohen of the Harvard Business School. Dr. Cohen, are you there right now, sir? You're on mute right now, maybe. Hello.
Yes, sorry, I just had to get unmuted. Yep.
Okay, so Dr. Lee, are you ready right now? Do you have specific questions on Professor Cohen right now? So.
Right, thank you very much. Actually, it's very nice to meet you online, Doctor. I have one question and one comment, actually, to share. The question is, we've been living in a society where shareholder value is the first, which is what we call shareholder capitalism. Now it looks like we are in the transition period to stakeholder capitalism, meaning that we have to meet the demands of the shareholders and also stakeholders involved in the investment, likewise employees and partners, government environment. So do you think it's possible to catch two birds? That's a simple question. And also, in terms of financial performance, valuation, well, ESG takes a long time, actually. So in that regards, do you think, where do you think we can find opportunities for successful ESG investment? That's my question. Thank you.
Great. Well, so in terms of shareholder versus stakeholder capitalism, look, it is very challenging when you are trying to optimize over multiple goals. And so, although I think there are very valid critiques of shareholder wealth maximization, I understand its appeal because it gives you something very simple and explicit to target. If the stock price goes up, you did your job well. And if you say, okay, what we're trying to do is take account of what's good for employees, retirees, taxpayers, the environment, all these other things, it's very difficult to tell whether you did the job well. Now, obviously, I think there is a good case that a really well-run company that is run in a sustainable way will produce value in a more across-the-board fashion. But I think that it's a fair comment on the part of corporate executives and also asset allocators to say, boy, you're really asking a lot of me when you ask me to optimize over all these dimensions simultaneously. And I haven't seen anybody give a formula to a CEO that says, here's how you should weigh the trade-offs between what's good for your shareholders, what's good for your bondholders, what's good for your employees, and so forth. So I think that it's a hard job we're putting on CEOs. And then similarly, turning to the question of ESG investing, it's a real challenge that we put on asset allocators when we say to them, hey, we want to have very high returns. We want you to manage risk well. And we also want you to achieve these ESG goals. Again, it becomes hard for them to know if they've done their job well. And so, I think it's worth our while as people who take these issues seriously to think about how we can create situations for both allocators and executives where they know what their goals are. And, they always say, if you can't, it's very hard to incentivize something if you can't measure it. And so I think, we should think hard about how to measure not just ESG success, but the combined success across these dimensions. Now, in terms of the question of what opportunities are out there in terms of ESG investing, I tend to focus, I think the most value can be added if we look at tipping points, right? Think about something like Tesla, right? As a general matter, as an individual, nothing you do is going to have a huge impact on the climate, right? As an individual, if you turn your thermostat down in the winter, or make other, decide to take fewer plane flights, that just really isn't going to add up to anything meaningful for the climate. But there are occasional exceptions. So, for example, when Tesla was a struggling young company, there were people who went and paid exorbitant prices to buy the original Tesla Roadster. And those people provided capital and evidence of a market that enabled Tesla to develop the Model S, and then people bought that, and that enabled Tesla to grow even bigger and start to build more charging stations, and that made it more feasible for other car companies to go and sell cars because people said, hey, there are enough charging stations that it's worth owning. And now it seems clear to me that we've passed a tipping point where it's obvious that almost all the cars in America will be electric in the foreseeable future. And whether that's going to be, I think it's going to be sooner than most people think. I think we'll be selling mostly electric cars here within 15 years. In other words, there was an opportunity there. People who funded Tesla and people who purchased Teslas made, I think, a permanent and enormous difference. And so I think that as an investor, if you want to have a high impact in ESG, what you need to do is look for investment opportunities where, if it works out, it can actually shift the dynamic and have these virtuous cycles as we've seen with electric cars. And those might exist in solar power. They might exist in battery technology. Imagine if you fund a company that can develop more efficient batteries, the changes that could make in the electric car business, in solar and wind, which have intermittency problems, and so on and so on and so on. And so that's where I would look for opportunities in terms of having a high impact with your ESG investing. Look for those tipping points.
Okay, thank you so much, Professor. And then since we don't have much time right now, I'm going to move a mic on to Europe here. Harold, are you there right now? Harold?
I'm here.
Hi, how are you, Harold? Okay.
I'm good, thanks.
Good. So as a former head of ESG here, now you're with a Natixis investment manager, and then what we see over here is very interesting sectors right now. Not too long, about a couple of months ago, I had a good chat with a couple of CIOs from pension funds in Korea and in public funds. What they're saying is because of COVID-19, the investment environments are pretty shaky, so they cannot do due diligence at this moment right now to overseas. So they're looking for a very long-term asset, such as real estate like this. Because of COVID-19, and then maybe it's very difficult to do the due diligence outside of like South Korea, if LP is based out of here, or the US or things like that. How do you see this? Is like, what's going to be the probably the promising sector or industry on the ESG investments era, except investment portfolio like real estate?
Well, I think that's a very good question, but a very difficult one to answer because going back to what I discussed earlier about on the ESG matrix and the fact that investors have different objectives in deploying ESG strategies. It depends. What are you looking for? I mean, is it a question of investing in companies and projects that align with your values, or that you're avoiding certain sectors that you have
you're very correct, right.
ethical problems with?
Yes.
Or are you looking for investments that provide good returns? Are you looking for investments that allow you to contribute to solving societal problems?
So what I'm asking you is like an LP perspective. So, as I said, you know what I'm saying then? Like, LP's perspectives, and then how would they find an interest in investments outside of Korea if the LP based out in Korea when it comes to ESG? And what are the sectors and industries maybe you could make a suggestion to win the battle in this COVID-19, and the ESG?
Well, I don't know if I'm well positioned to answer that. I think, obviously, I see that that COVID presents some challenges, but at the same time, in my view, in the world of investment, things have continued pretty much as is, and people have adopted to these new circumstances. So due diligence is happening as it was happening before, but perhaps through Zoom calls and so forth, and not through site visits. I think maybe just also going back to what Randolph just said, I think if LPs or pension funds are looking for ESG investments, and it's out of a genuine desire to contribute to to solutions, then focus on industries or companies where there's a real tipping point. Industries or activities that require certain support, that have limited access to capital, that companies that will allow new markets to grow, for example, in green technologies. And the other thing I would say is maybe not sort of a direct answer to your question, but I think there's also, with smart pension funds and LPs, I think there's a recognition that the role of government is very important also in allowing these new markets to emerge. And so I think there's a lot of opportunity in investors working together with governments. One of the things that there's quite a lot of interest in right now is something called blended finance, which is effectively where governments and private investors work together to make investments that otherwise could not take place. And so that requires sort of proactive engagement from both sides. So that's also something I would say, government has such an important role to play in all the things that we talk about when we say ESG or sustainable development goals. We should recognize that they have this role and see if we can support them as investors.
Okay, thank you so much. I think there was a perfectly attuned answer here. So finally, I'd like to ask a question to Hana Ventures, Mr. Kim. For speaking of Mr. Kim is heading one of the very conservative groups, Hana groups in Hana Venture segments right now. In that sense, I think Mr. Kim has different ideas, and then when you work with policymakers and everything, according to his experience with the SoftBank, he also deals with a lot of young pioneers, young venture capitalists, young company leaders, and etc. So, how do you see the ESGs when you took a look at this symptom right now? How is your company's policy? Do you have any internal policy to promote the ESG investment sectors? And if you could have answer these questions, and also maybe if you'd like to say something about the ESG investment, they'd be appreciated too.
We are initial stage of developing the ESG structure in decision making and the deal sourcing. So nowadays, we firstly focusing on the decision making process. Most of our venture capitalists are young generation. Mostly they are late 20s and mid 30s. So they are very focusing on the fairness issue in decision making. So we gather information from the very juniors to seniors in the same level. So in decision making, we try to get the junior levels opinion in making the investment decision in our process. Yeah.
Okay, Mr. Kim, thank you so much. 시간 관계상 이제
Due to time constraints, we will have to wrap up our discussion session We have many people joining us from different areas. Mr. Randolph, Cohen, and Harold, and Dick, thank you very much.
For this seminar again. Appreciate it. 또한 참가해주신 김동환 대표.
I would also like to thank Mr. Kim, Mr. Lee, Professor Lee, and also Mr. Lee. We'll see you again next year. Thank you very much. Thank you. So this was a session on ESG applications to HF, PEF, PDF, PCF, and real estate infrastructure. That was a very heated discussion. We were connecting from different parts of the world, from Shanghai, from the United States, and Korea, to talk about where ESG stands in the market environment. I hope that this session was useful to every one of you, and we're going to move to the last session of the day, which is a wrap-up session. Changes in the alternative investment from ESG, opportunities and challenges. This is going to be a discussion and policy proposal session. The session will be moderated by CIO, Mr. Chung Dong-han from Public Officials Benefit Association. Panelists are Shin Wang-kwon from MPF Management Committee, Mr. Ho Sung-moo from Korea Scientists and Engineers Mutual Aid Association, Mr. Kim Hee-seok, Hana Alternative Asset Management CEO, and Mr. Ted Lind, who is the chairman of BCC Global. Let's invite the speakers to the stage. Now let's begin the final session of the day, wrap-up session. The mic is yours, Mr. Moderator. Hello. This is the final session of the day. ESG in alternative investment, opportunities and challenges. A moderator of the session, I am CIO Chung Dong-han from Public Officials Benefits Association. Nice to meet you all. Now, all throughout the day, we've had heated discussions with experts and professionals from different parts of the world. And we've come to the final session of the day. We have had a lot of discussions, but ESG is a common theme of discussion around the world. As you may be very well aware, ESG is not something that just came about all of a sudden. As far as I remember, for about last 20 years, we were using different terms, but to mean ESG. And with COVID-19 hitting us all of a sudden last year, ESG became a very important theme for investors around the world. It has become an interesting topic for us all in the investment community. I understand that there are a lot of discussions underway on ESG, but this is really not at all a very new topic, not something to be scared about. If we make thorough, consistent efforts to prepare for ESG investment, I think things will turn out for the better. Now, we have panelists with us today, 4 panels. Let me first introduce each and every one of the panelist group. We have Mr. Ho Sung-moo, who is the CIO of Korea Scientists and Engineers Mutual Aid Association, and Mr. Kim Hee-seok, CEO of Hana Alternative Asset Management, and Mr. Shin Wang-kwon, Chair of Council on Investment Policy at NPF, National Pension Fund Management Committee. And I understand we're joined by Mr. Ted Lind, the Chairman of BCC Global from China. because this is the final session, as noted earlier, we have asset owners and we have asset managers and also National Pension Fund, Council on Investment Policy, who's involved in decision makings and also deliberation on ESG policies. And also we have an expert from China, what trends that we see in the Chinese market. I think we can have a diverse discussion. So we will try to look at where we stand, and because this is a final session, we want to be able to come away with policy proposals if we can, if that is possible. But as noted before, ESG is an ongoing theme. It would be difficult to come up with any definitive or conclusive ideas on that. As a disclaimer, now, in the interest of time, I'm going to invite the first panelist, Mr. Seoungho, CIO of Korea Scientists and Engineers Mutual Aid Association. It is one of the leading pension funds in Korea. You're responsible for operating and managing the funds at your association. How is ESG affecting your investment decisions and investment management processes? And what are your future plans for developing ESG investment? Seoungho, please, the floor is yours. Thank you.
안녕하세요. 과학기술공제에서
Hello, I am Seoungho. I'm the CIO of Korea Scientists and Engineers Mutual Aid Association. ESG, each factor comprising ESG, they have different significance and different meanings. For example, when we mean by the environment, it's about climate change and aggressively addressing climate change and social responsibility. That's something that has been talked about quite a lot, and governance is also viewed from a different light. And if we look at it from the lens of environment, now investment is about allocating capital and impacting the industry across the board. For example, the butterfly effect is a term that we can think about. And this investment is likely to have a major impact and major differences to many companies, and it's difficult to predict exactly what the size of the impact will be. Now, ESG scores need to have more credibility from the community. Rather than looking at it from the exclusionary lens, we should actually focus on positive screening to actually put more focus on ESG investment from a positive point of view. Carbon zero energies are used, and this is bringing changes in terms of mode of transportation and also to increase productivity. They're merged together with the ICT. That creates a lot of changes and will have a lot of impact on our investment. Now, those companies that are making a transition to net zero emissions, or industries that are making that transition to carbon neutrality, we're trying to have more bias towards those companies in our investment allocation. And in terms of the fixed income investment, that's for the equity side. And those companies that are able to become accustomed to the changes that will be taking place in the net zero world, those companies are some of the ones that we'll be looking into. And we also need to mitigate CO2 emissions. Now, we're not going to be, for example, excluding those companies from our investable tools that are emitting CO2s. But over the years, I think we will have less and less investment in the companies that are emitting a lot of carbons. So thank you very much. The CIO of the Korea Scientists and Engineers Mutual Aid Association gave us a high-level view on how ESG principles are applied to investment.
또 중요한 또 국내
기관 투자가들의 자금을 받아서 많이 운용을 하고 계시는 하나대체 투자자산운용의 대표이사님이신 김희석 대표님께 최근에 이런 국내 LP들 또 이런 에셋 오너들의 여러 가지 ESG
Next, we would like to invite Hee-seok Kim from Hana Alternative Asset Management, who is the CEO, and I would like to hear from you what your plan is going forward on your future investment policy for ESG. Good afternoon. My name is Hee-seok Kim from Hana Alternative Asset Management. I was here throughout the morning session, and we had a lot of discussions in the afternoon session as well. It's been quite a long time since we started to talk about ESG investment globally. I believe that the history of this topic is about 40 years, and even in Korea, we've been talking about this issue for about 15 years now. When you think of ESG, basically it dealt with sustainability of a company, dealing with non-financial indices. So in the past, from the perspective of investment, we tended to think that you would have to give up your returns for the sake of public good, which was the main reason that the public institutions were mainly interested in this topic. But as was mentioned by the moderator, there has been an increasing level of interest in ESG investment, even in the private investor community, and an increasing number of investors are moving to implement ESG investment policies, which is the reason that I believe that the environment is ripe for us to execute this strategy. We are an alternative asset manager ourselves, and the topic today is ESG investment. I believe that it's easier for us to do ESG investment in the equity market because you can build a portfolio consisting of the companies that are friendly in terms of ESG. But when it comes to alternative investment, there are more challenges. For instance, there are many different sectors in alternative investment. In the case of infrastructure, we can think of the discontinuation of coal-fired power plants and so forth. But infrastructure investment is not the mainstream area of alternative investment, and you would have to go to the real estate property market for more mainstream investment. In the past, we preferred buildings that accommodated the greatest number of people so that they can work most efficiently. But now we're placing a focus on those types of office buildings where an appropriate number of people can work in a pleasant working condition. So when we build a real estate investment portfolio, for instance, we could consider smart buildings where environment-related emissions are reduced. Or, for instance, the buildings could use just about 28% of the energy consumption that used to be required by traditional buildings. And there are other ways that can increase the efficiency of buildings from the perspective of ESG, right from the beginning of the development phase. We are working with our partners to create a mandate for making such an investment. From the viewpoint of investors, as they make ESG investment, they also need to achieve a return on their investment. Accordingly, I believe that there needs to be a process of making sure that you can achieve returns even with the ESG investment. Thank you very much.
From the asset manager's point of view, especially in the real estate market, how ESG principles will be applied and how to expand that concept going forward. So that was a gist of your comments. Next, we're going to invite Mr. Shin Wang-gon, who is the Chair of Council on Investment Policy from MPF Management Committee. This is the largest MLPs in Korea, and it is one of the 3 largest pension funds in the world. So it'll be very interesting to hear from you in terms of the ESG investment policies. Hello. I am from National Pension Fund Management Committee. I'm the chair of the Council on Investment Policy, Wang-gun Shin. As a matter of fact, the AUM of MPF was 73 billion in 2019, but now it's 83 billion 2020. And as of the end of June this year, it is now surpassed 90 billion AUM. So we're seeing rapid growth in terms of the asset under management. We're one of the three large pension funds in the world. And ESG is actually called responsible investing at MPF. In managing the funds, we have 5 principles in terms of liquidity, publicness, and independence, and 5 principles that we should honor. And a new principle we're trying to add is sustainability piece. So while being sustainable, we're also that actually became a basis for defining our policies for ESG investment. And among the equity investment, among the brokerages, we have a style fund with a focus on ESG, and we did this for the first time in the market. Now, the stewardship code is a requirement, and it is also being widely adopted. And the Korean version, K Stewardship Code, was introduced. And together with the trend, the fiduciary responsible principles and responsible investment principles were established, and the relevant guidelines were put in place. Now, RI, responsible investment, is carried out in 2 directions. First is ESG is about non-financial factors. In the overall decision-making process, together with the financial factors, we're trying to apply ESG principles to our investment. That's a part of an integration process. And second, in terms of the equity investment, the large NPF has about 10% of equity in large companies. Although we're a minority shareholder, we have an absolute shares or equity in the companies. Because we're in the investment for long-term horizon, we're long-term investors. We don't just easily liquidate our positions. And we also have to make adjustments to our positions according to the benchmark. So we look at quality companies, and we have to buy and hold our positions for quite a long time. So for those companies that we're investing in, we're trying to become active owners. And we have engagement and communication with the company CEOs. That's part of our responsible investment principle. So we had stylized funds in Korea, but as we are witnessing a new trend, we're becoming active investors by introducing ESG scoring criteria. It starts with AAA, B, C, and D. There are 6 different levels of ESG scoring. We do monitoring or evaluation based on the scorings 2 times a year. And that becomes a basis for integration for active and passive investing. And as a passive investment, ESG also applies. But for now, this was also only limited to the domestic equity. But in the second half of 2021, we're now applying the principle to fixed income in Korea. And starting next year, for overseas equity and bonds, such policy will apply. The 900 trillion AUM that we have in Korea, that's going to cover not only the domestic market, but overseas market in terms of equity and fixed income. The topic of the conference is ESG and alternative investment. Explicitly, MPF, until 2023, within the current framework, we will not be able to make a passive, active investment in alternative investment. Of course, we will try to integrate ESG principles across the overall investment process. But we do not have the defined framework in place for the alternative investment. Perhaps this is mainly because of the treats the alternative investment. Although the MPF is managing a very large pool of money, but alternative investment, we do it through the GPs. So we'll share in the views of the GPs, the ESG policies or the issues or the perspectives of MPF cannot be just directly applied to such investments. But from the point of carbon neutrality, NPF has made a declaration to decarbonize our investment and also to actively address climate change in our fund management. We have just begun doing that. So that is going to be a very important guiding principle. So in terms of power generation and energy sectors, CO2 emissions and the large emitters related investment will be scaled down, and we will increase our portion of investment in environment-friendly companies. So for the alternative investment side, those carbon industries, our exposure to such industries will be scaled down, and we will move towards alternative investment with more eco-friendly focus. And ESG principles will then be widely applied to alternative investment. Because we're a large LP, we have a large responsibility to fulfill when it comes to ESG investing.
감사합니다.
Thank you for your remarks. Well, today we have heard from the three panelists from Korea on this important topic of ESG investment. Each of you have mentioned the types of strategies and considerations that you're making at your own institutions. Now, let me invite Mr. Ted Lin, Chairman of BCC Global, who's connected with us from China. Can you talk about the overall ESG investments landscape in China, and what are the sentiments on the part of the GPs, LPs, and so forth regarding ESG investment? What are the moves that they are making at the moment in China? I hope that it will be very meaningful for us if you can share your views on these topics. What is the ESG investment landscape in China?
Thank you very much, Dr. Chung. So my name is Ted Lim. I'm calling in from Shanghai. Our company is called BCC Global. We are a primary research company where we do external work and due diligence work for our clients. Our clients are both GP, LP, consulting firms, and corporations in China. So from my perspective, I interacted with a lot of funds in China and also a lot of LPs that invest in Chinese funds. So I'd like to share a few things regarding the China market. First of all, I want to talk about the status of the Chinese ESG market. Second thing, I want to talk about the areas where people might be interested in ESG investment. And thirdly, I'd like to talk about doing ESG investment. Before I start, I just want to very quickly mention about Professor Cohen. I don't know if he's still around. When I was at Harvard Business School, I took Professor Cohen's investment strategy class. That was 16 years ago. And I found that he's still super sharp and he still talks very quickly. So kudos to the real-time interpreters out there who were able to translate his PPT. And the last point about Professor Cohen is that he gave us so many investment tips about stock market that I made enough money to pay for my ESG. So that aside, let me talk about the Chinese ESG market. So historically, the challenge for Chinese funds has been a lack of ESG understanding. And when I say historically, I mean about 3 years. 3 years ago, I started hearing about people talking about ESG in China. So the funds that started doing this are, for example, Harvest Fund, That's one of the biggest mutual funds in China, and also CITIC PE, CITIC Private Equity, which is one of the biggest private equity firms in China. So back in early 2018, they started talking about setting up ESG committee and doing ESG funds. But those are far and few. About this past year, ESG has taken off, especially in the last 6 months. I think I see news on news every day in China. The reason the ESG understanding is low in China are two. One is there is a very low level of ESG data disclosure by insurance companies. They has alluded to 25%. And the other thing is there is a lack of audited or comparable ESG data points. So these make it very difficult for Chinese funds to develop an understanding of ESG issues. However, Chinese funds are now looking at their American and European counterparts to help them improve their understanding of ESG. Any funds in China that raise money from US or Europe would have to go through an ESG audit. The LPs will ask them to fill out a long questionnaire, and that would, discuss about their portfolio companies, their investment strategy regarding ESG. And I'm sure that's something that, Korean LPs are doing. But what really put ESG on the map of China is the national policy of 2030 and 2060, which Jay has alluded. So by 2030, China would like to achieve carbon peaking, meaning that by 2030, China will emit the most amount of green gas clouds. And after that year, the emission will go down. By 2060, there will be carbon neutrality, meaning that it will be net zero emission for greenhouse gas in China. And I think that's a tipping point for ESG in China. And then this is almost becoming a national level policy. And in China, when you have a national level policy, that's a mandate for companies to follow. So I think the goal is really, the common goal is really the priorities for the Chinese fund to focus on following things. So the second point I want to discuss is what are the sectors that might come from this China neutrality policy Chinese government has put out. So the first one would be fight against poverty that's related to ESG. That includes the fair pay and child labor. The second is promoting green development, right? Biodiversity, support for green initiatives, also ESG related. Third is technological innovation, R&D, spending, supply chain risk, and so on. ESG related. Fourth, environmental expenditure, standard of workplace safety and social health, employee turnover rate, and so on. Let's say it's still ESG related. Lastly, anti-corruption, which probably related to governance, but I think for funds it's less relevant. For Chinese government to do this, there are two goals, two main goals. One is they want to become the leading manufacturer of green technology in the world. The second thing is they want to reduce dependency of imported energy, which are for both prosperity and national security. So that aside, we have the status of Chinese ESG and also the field where interesting investment opportunities lie. I want to talk about the benefits of doing ESG in China, right? So first of all, we will help if you have Chinese investment. We'll help the funds identify China-specific indicators to further enhance the robustness of their existing framework and localize. Secondly, to help convert some of the qualitative indicators in their existing framework to quantitative. So from qualitative to quantitative scores. Thirdly, to help them assess portfolio companies' ESG package relative to peers. And when I say peers, I'm not talking about global peers only, but also local peers, and how they may have changed over time. So in terms of trend analysis. Lastly, our company does management background checks and fraud checks on companies and funds. And this is highly relevant to the governance in ESG. So if an investor is able to find out there's a governance issue in the company, they will have less chance of investing in a company that might go explode, right? For example, Lucky Coffee or Final Forest, it's a Chinese example. For any company that invested in fraud, I think they will lose some of the confidence from the LPs. The LPs will be thinking, you either have done your due diligence well that you don't invest in fraud, or you are complicit in the fraud itself. So I think for any fund, both GP and LP, doing enough due diligence will help them improve their ESG score. So those are the key points I want to share regarding ESG in China. One last point I would mention is, I think for the discussion so far, we have talked about the LPs looking at GP ESG package. But I would say the other way around is very important. I think the best GP actually look at LP ESG track records and policy, and they want the best LPs to invest in. For those LPs that de-emphasize ESG, there is a good chance that some of the best GPs might avoid it. I think for the best GPs, source of money is not an issue, but finding the best source of money is important. So that's my talk, and happy to discuss.
네, 감사합니다.
Thank you very much. Chairman of BCC Global, Ted Lin, talked about the current market circumstances around ESG investing. I think at a high level, the Chinese government is focusing on carbon neutrality and other environmental goals and corporate governance structure improvements. A lot of reformative measures are undertaken by the government. So I think it goes along the same lines as the Korean government's policies. So across the board, regardless of which country that we're speaking of, yes, of course, the final session is very much focused on what is going on in China and Korea. But in the morning session, we looked at other advanced markets. I think they are concerned about similar issues. ESG is indeed a global phenomenon. With that said, we've heard from different institutions, their perspectives. Now, I'm going to delve into closer micro-level issues. Now, ESG is a very nice word, but we are not exactly sure what it really means. There's a lot of ambiguity, vagueness around ESG. But we want to use this wrap-up session to focus on the opportunities and challenges to alternative investing from the ESG lens. So first, focusing on opportunities. At the Public Officials Benefit Association, we do have a lot of exposure to alternative investing. And for the past few years, we've seen massive changes in the alternative investing for ESG. For example, only a few years ago, when you go to overseas conferences, when we start to have a discussion on ESG, I even thought to myself that that is something that is remotely related to our market. Very just a theme that will always be addressed at a conference, but not really doesn't mean anything. But when it comes to alternative investing these days, I believe that ESG is becoming a mainstream topic. But what's important is that from the point of looking at opportunities in alternative investing, can ESG investment lead to profits and returns? We have no choice but to ask that fundamental question to us. And I will answer that question first and ask other panelists to join. In the past, ESG dealt with social issues for marginalized, disadvantaged classes in society at the expense of returns and profits. However, in recent days, things have changed. What I see in alternative investment is that you don't have to necessarily sacrifice your returns, but an adequate level of returns can be secured. And on top of that, social and other positive impacts can be created, especially to fulfill our fiduciary duty as a public pension fund to our members in the fund and also the general public. Their aspirations can be represented in our investment. And I think that's very meaningful. So we don't have to necessarily sacrifice returns in alternative investment. I think there are a lot of opportunities to be explored. And I want to hear other panelists on this issue. Mr. Hawk, please. Well, I've heard the term, for example, making very heavy investment in those good companies and good businesses that are doing something good for society. Now, the economy as well as our culture have grown significantly, and I think people are paying more attention to meaningful causes of society, even at a higher price, that they're willing to pay more for companies and goods that do good for society. So the reason we're having this discussion in the first place is because society is placing higher priority on sustainability. How to measure social responsibility in alternative investment and how reliable that score can be. I'm not exactly sure where we stand, but when it comes to individual project or when we are making individual decision, if there are ESG aspects to be considered, then we can have more exposure to such investment themes. And at our company, about 300 billion won of investment is made in near metropolitan areas to provide housing for young generations. 500 households have already moved into the complex. Although we're making equity investment, if you look at risk-return profile of the investment, is very much focused on debt, fixed income, and it is long-durated funds. So we're trying to work for publicness and looks like equity, but it has the characteristics of a bond. And I think we can create alpha on top of the bond yields. And looking at demographic changes and urban changes, and I think the value of those regions near the metropolitan city will go up. And benefits that are created from such projects can be shared with younger generations and the public. And it will make significant contributions to our overall property market, and it could also create jobs for young people. So we call it social investment, but I don't think that is going to eat into our returns. Rather, it will create alpha for our investment. That is how we're doing at our company. Thank you.
Thank you very much. Now let us hear from Mr. Kim of the Hana Alternative Asset Management. I think you've made some good points yourself, Mr. Moderator. We've been talking about ESG, and we tended to think that we needed to sacrifice returns for the sake of public good. And we were satisfied with a less desirable level of returns. But COVID-19 is causing a lot of transformations. For instance, in our case, when it comes to infrastructure, the abandonment of coal-fired power plants is something that is very noticeable. And we are moving towards renewable energy sources such as solar energy. The government has been maintaining a fixed price of electricity in the Korean market. And from that perspective, ESG investment is somewhat relying on the support of the government. In the case of the wind power generation, if you look at the technology development involving wind turbines and so forth, there has been the effect of price drops. So we are starting to gain greater efficiency. And in this respect, even without the support of the government, I believe that we are creating space for ourselves where we can make greater ESG investment. Also, at the same time, there are some challenges when it comes to alternative investment. If you think of the real estate investment, in the case of smart buildings, and this is what they do. They transition to LEED certified lighting system and so forth so that they can get certified under the LEED. And by doing so, they can cut down on the operating cost of the buildings. But now they are taking a step further, and this is what I am witnessing. Profitability of office buildings has to do with the fact that they needed to accommodate as many people as possible inside the buildings. But with the expansion of contactless interactions with the pandemic, things are starting to change. In the past, we used to think that we are in the shortage of office building space, but now it's a completely changed landscape. For instance, we can have just about 40 people working inside the buildings, and we can utilize the rest of the space inside the buildings for other purposes so that the overall utilization of the building space is increased. So there are changes in the mindsets of these people. Of course, there should be the agreement or a buy-in from our customers for these types of investment, but I am starting to see the change myself. I don't think that that type of ESG investment in the real estate market is booming at the moment. But as I see the signals of changes among investors in the near future, even from the commercial perspective, people will be expecting and actually realizing returns on ESG investment. Thank you very much. Now, let me invite Mr. Shin for comments.
Well, rather than focus on individual investments, as moderator pointed out, people are not really clear about what ESG investing really means. We have 900 trillion won in AUM at MPF, so really have to take a broad and long-term view. Why is ESG investing receiving all the limelight? Perhaps because in the past, corporate governance, social responsibility, or responsible investing have been hot topics, but I think it's because of the climate change, trying to keep the temperature rise to 1.5 degrees Celsius. This initiative has been driven by the European continent, especially by UK. Various concepts were disseminated by the country. What they're saying is green finance related to climate change. If you look at the definition of green finance, it is about greening finance or financial decisions or finance green. So it's investment on green. So that's perhaps what we're doing when we're talking about ESG investing. But ESG is not going to be a fad. It will be here to stay because all decision-making process will become greener. That is a mega trend that we have to take note of. Equity, bond, traditional assets, as well as alternative investments and relevant investment decisions will take into consideration sustainability aspects and also to strike a balance for our future generations because we have to provide a service to our beneficiaries and how to make sustainable investment decisions. That will be important. So our funding decisions will become greener. And I think there are a lot of issues that we can address if we take that broad view. Thank you.
그러면
Thank you very much for your comments. Ted, can you hear me?
Yes.
okay. Do you have any comment on my second question?
Just very quickly, I think I agree with Professor Cohen's point where it's very hard to optimize all dimensions for ESG investing. If you are looking for shareholder return and you are looking at all different requirements, it'd be very difficult. I give an example. Professor Cohen mentioned about Lockheed Martin. In China, there is a company called Relax. They make e-cigarettes. For those who are, if you go with strict ESG terms, you shouldn't invest in a e-cigarette company. But if you look at the other side, you will see that people who smoke cigarettes are usually people who smoke regular cigarettes. So if you are able to smoke e-cigarettes, you actually reduce the pollution and reduce the health issues. So net is actually better than if there is no e-cigarette. So in a sense, for an investor to decide if this is a good investment or not an investment, it's up to interpretation. My take is if you take a long-term shareholder return as a major stake, ESG can be a reminder for any CEO or investor to remind of a risk and make adjustments for long-term shareholder return. So that's my short answer.
네, 고맙습니다.
Thank you for your comments. Due to time constraints, of course, it would have been great if we could cover many more topics. But I think we briefly mentioned opportunities that we are provided with regards to ESG. But also, I would like to address the topic of challenges related to ESG. Maybe this is something that I can share with you as a real-life example. In our organization in Pangyo, we made an investment in office building in Pangyo. 3 years ago, LEED certified building was the one that we wanted to invest in. We made sure that the building is constructed to the LEED certification standard. With that certification, I understand that the pricing of the building is adjusted slightly. And for instance, the office buildings with open space like a terrace, outdoor terrace, are more highly evaluated. This is another ESG factor that I think is created by the COVID-19 pandemic. As was mentioned, I am addressing ESG-related challenges, and let me share with you what I felt at my organization in terms of the challenges. I also would like to pose the same question to other panelists as well. First, as you must be well aware, in the recent years, cryptocurrency has been attracting a lot of interest from investors, and it is becoming one of the fields in alternative investment. Real estate and infrastructure assets, I don't know where to put cryptocurrency in which asset class in alternative investment, but anyhow, there's a high level of interest in these types of assets. As you are aware, in terms of operation, the cost is very high. So in the case of these assets, as they consume a lot of carbon energy, how to design energy sources is a key in ESG investment. The success or failure of the investment will be determined by the design of energy sources. So I believe that you need to gain a better understanding of this aspect when making investment in these asset classes. One more thing to add is based on the data that I've read recently, e-commerce reduces the carbon consumption by half when compared to the traditional shopping method. And as a result of that, there has been an increasing demand for logistical centers in the real estate market. And I know that there are pros and cons of utilizing these large-scale logistics centers. But for the sake of carbon reduction, I believe that there are pros to making investment in these logistics centers. Accordingly, although we'll have to consider opportunities, we'll also have to understand what challenges are associated with a particular ESG investment. I know that all of you are involved in making actual investment in the ESG-related alternative assets. So as you execute your ESG investment, what are the challenges that you faced?
Well, as you mentioned, in the field of alternative investment, from the point of ESG, I think there are a lot of opportunities to explore for E, because going back to the housing project, I think that's more related to S. When we are, for example, importing LNG, it is in the liquefied form, and it has coolant as an energy source. And if on right next to the LNG terminals, if we establish cold chain centers, through the gasification process, the heat or the energy that is coming from that can be used as a cooling energy. And also bioenergy is growing. And if we keep it at minus 40 degrees Celsius, and the expiration date for the products that are kept at the storage can become longer. So we can utilize these energies created from the facilities. So we also need such energy sources to cool down the air conditioning facilities. We don't have to, for example, emit that into the ocean, undermining our ecosystem. We can recover that and cycle that back to energy savings. So if you look around us closely enough, I think a lot of opportunities can be sought for ESG investing. And I think E and S are very commonly adopted by people for ESG. But G is a notion that we have to be careful about. Reason we have a Korean discount for stock market, it is because the majority shareholders, for example, they're taking away jobs, or they're tunneling their jobs, opportunities for others. So again, corporate governance issue is very important. If we just look at corporate governance issue alone, people say that we need to make the system more advanced and sophisticated. But if we don't do it well, then it could stifle entrepreneurship that could undermine the driving engines of growth. So when we're dealing with the issue of G, we have to take a broader perspective, not just taking a silo approach, because there are many interests at stake. For example, taxation should also be linked to that. Tunneling, or because of the inheritance tax, we see a lot of inheritance tax related to the corporate governance. Perhaps we can reduce the rate of inheritance tax, or property tax can be increased as a substitute so that we can address corporate governance issues more effectively.
Thank you, Mr. Kim, please. I don't think I have anything particular to add myself. Maybe this is something that's not directly related to your question, but as I work in the field, for us, E and S are more relevant for our investment, but sometimes I see some conflict between these two. For instance, when we build a renewable energy farm or a wind farm as the source of renewable energy, of course, the energy that's created is eco-friendly. However, it will create noise for the residents of the community, and we might face opposition of the people there. Still, we would go ahead with the construction of wind farms. So in this case, there is a conflict between E and S factors. So what we can do instead is to have the residents of the community participate in the project themselves so that we can seek collaboration. And as we make real estate development, we will not be developing a mountain, but most oftentimes it will be developing residential areas. And in that case as well, there could be some conflict between E and S. In other words, it will be important for us to try to minimize the potential conflict between E and S factors as we pursue ESG investment. We're in the early stage of ESG investment development in Korea. I hope to see more pros than cons, and I hope to see more positive examples going forward. Thank you.
Thank you, Mr. Shin. I'll make my comments brief. I don't do direct investment at MPF, so it would be difficult for me to cite any specific examples, case studies. But our alternative investing size is about 90 trillion won at MPF. And to break it down, we have private equity ventures, real estate, and infrastructure investments. That's about 30 to 25 trillion each. But from the MPF's point of view, we're going to put more weight on PE going forward. And currently, the portion is 10%, but we'll increase our weight to 13%. We're underweight right now in terms of alternative investment. So we'll be expanding our exposure to private equity going forward. In 2021 alone, the new commitments is about 19 trillion for PE. And from the point of view, ESG, rather than private equity, I think a lot of people talked about real estate and also infrastructure. There are various opportunities and challenges to be explored. We'll have to fine-tune our strategies. But MPF is a long-term institutional investor with massive AUM and alternative investment. We would still have to take a long-term approach. We will have to thoroughly review and have close consultation with GP. And we would have to take a very active approach towards that so that we can become a leading institutional investor. And it could create a lot of opportunities for alternative investing, although we don't have a specific action plans for 2023 up until that period. But I think we will be able to come up with the more specific strategies for alternative investing going forward. Thank you.
Good.
Thank you. Next, Ted Lin, can you hear me?
Do you have any comment?
Just very quickly, I think the biggest issue on ESG is really what Professor Chung mentioned this morning. There are a lot of different opinions on how to do ESG, and there is no one central definition of ESG. So we have a lot of certification entities, but we don't have very authorized ratings agencies such as Standard & Poor's or Moody's in the ESG space. So I think once we have those, it might take some time to develop. We will have a much better framework for ESG to continue going. That's it.
Yes. Today, we heard from 4 panelists today. regarding the ESG in alternative investment. To wrap up our discussion today, this is what we've discussed in my opinion. This is the overall picture that we're dealing with. There are many inevitable aspects that are leading us to making ESG investment, and there could be some sacrifice that we probably would have to make when making ESG investment to pursue ESG factors. But this is something that we've discussed today. This is not something that we can avoid ourselves. And this is not something that our country can avoid. Is there a solution for us to avoid this? I don't think so, because this is such a huge wave of investment trend. I think the sooner that we accommodate this trend and try to come up with a wise strategies to pursue this, the better for us. I believe that it will be wiser for us to try to put our heads together to address the challenges that we discussed related to ESG investment. We've examined ESG-related opportunities and challenges in the alternative investment space. And when it comes to alternative investment, if you try to read the ESG trends, rather than in the public market, more so in the private market where there are more specifics and quantifications. For instance, in the space where we can do impact investing, there seems to be faster paced development and advancements. So from the perspective of ESG investment, in alternative investment, I think that investors would be better placed to accept the trends as quickly as possible and take the lead in promoting this trend in the future. I would like to take this opportunity to thank all of the panelists today. Thank you.
Thank you. We've come to the end of the program. It's time to say goodbye. I'd like to thank all the audience and participants for their enthusiastic participation. I hope that you have learned a lot from today's conference. This concludes the GAIC 2021 Global Alternative Investment Conference co-hosted by KG Group and Edaily. I am Park Hae-yeon. Thank you very much.